It's 9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief.
Good morning, everyone. Stock futures moving slightly higher this morning, building on last week's gains that saw the Dow close at a record high on Friday. Tech is the leader this morning after the risk-on rally sparked by the Fed's rate cut pushed the Nasdaq up 1.5% last week. We saw weekly gains for 6 of the 7 Magnificent 7 members, with AI darling NVIDIA as the sole laggard.
And Fed officials are backing the central bank's 50 basis point decision, a 50 basis point rate cut last week. Atlanta Fed President Raphael Bostic saying there's uncertainty about whether both inflation and employment goals are fully within reach. Minneapolis Fed President Neel Kashkari releasing an essay this morning warning about ongoing weakness within the labor market. CME Fed Watch is currently pricing in even odds for a 25 or 50 basis point cut in November. Fed Chair Jerome Powell is scheduled to speak on Thursday.
And Apollo has offered to make a multi-billion-dollar equity-like investment into Intel. This is according to a Bloomberg report, and Apollo is the parent company of Yahoo Finance. This does come after the Wall Street Journal reported Qualcomm approached Intel about a takeover bid. Intel has struggled with increasing competition in the chip space. Shares are down more than 50% so far this year.
Stocks coming off a record-setting week as Fed officials defend the central bank's decision to cut interest rates by 50 basis points. Atlanta Fed President Raphael Bostic saying the time has come to normalize policy as inflation moves back to the Fed's 2% target. And Minneapolis Fed President Neel Kashkari writing in an essay released this morning that the risk of further labor market weakening warrants a lower federal funds rate. Joining us now, we want to bring in Chris Watling. He's the founder, CEO, and chief market strategist of Longview Economics. And Chris, I guess my question to you is what the market is pricing in versus what we are hearing from the Fed, because still, as we have said, laid out in that intro there, CME Fed Fund futures still pricing in even odds of a 25 or 50 basis point cut in November. Is the market still getting a bit ahead of themselves comparing that to what we're hearing from Fed officials this morning?
Yeah, look, I mean, the market's pricing in. I think the market's sort of deeply divided. It's sort of poised on in between pricing in a recession and a soft landing. I mean, if you think historically, in a soft landing, you would have 1, 2, or 3 rate cuts. In a recession, you have 500 basis points of rate cuts. But the market's pricing in a sort of aggregate out to the end of next year, about 250 plus, including the 50 basis points we just had. So, they're looking for a couple more this year, maybe 150 in there, but 225s. I think the asset prices, the bond market, the equity market, there's deeply divided debate about where we go from here. There's a lot of confusion out there. So I would say the market's poised in between those two scenarios. Is the US economy going to achieve the Goldilocks soft landing, or is it going to actually roll over into a recession?
Yeah, Chris, what does that tell you about the terminal rate, especially given what you were talking about with the markets trying to price in a few percentage points of ultimate cuts at this point as the Fed has initiated that cycle?
Well, I mean, maybe there's an argument that what we're pricing in, sort of rates down at 2 3/4, 3%, is what the market thinks is the neutral terminal rate. And sort of we had that kind of number out of the dot plots last week. But I mean, the reality is these kind of questions are incredibly difficult, and no amount of complex equations are going to give the answer. The terminal rate itself changes depending on the structural strengths and weaknesses of the US economy. After the global financial crisis, as everyone's deleveraging, it's much lower. Now, I would argue that the private sector, households and corporates are in much better shape. The terminal rate is probably higher. So I would guess 2.5 to 3 is a sort of reasonable number. But I think the market's got more to think about before it gets to that question. In other words, are we going to have a recession, or are we going to have a soft landing? Or actually, there's a third scenario. Maybe this US economy is clearly slowing at the moment, but maybe it can reaccelerate quicker than people think, which I think is an interesting one to ponder, and quite important for a whole load of asset classes, including equities, bonds, gold, all of these. So, yeah, terminal rates, it's a great debate, but I think there's more to think about before we get to that point, if you like.
Chris, given those 3 scenarios that you just laid out there, and given the uncertainty that we are likely to see here over the next several months, what advice do you have for investors? Are you giving your clients right now, just in terms of how they should be positioning?
Well, I think it comes down to your view on that US recession or soft landing call. And we're minded to believe that actually this economy can start reaccelerating almost on its own, not with a few rate cuts, just not a full sort of panoply that's priced into asset prices at the moment. So maybe it's another 50, maybe another 75, and so we're watching very closely lending data. We're watching the mortgage apps. We're watching the idea this housing market in the US could start reaccelerating without a lot more falls in the mortgage rates, and I know that's not a consensus, but I think that's important. So I think you'll get a soft landing and probably a pretty good reacceleration. And that influences where you put money in terms of equity sectors and bonds and gold and things like that. So that's our sort of first key question that we're looking at. And that leads us to the view, of course, that bonds are pretty overcooked here. They're pretty overbought. Yields are at pretty low levels. We're seeing them start to back up on the back of the 50 basis point cut last week. It leads us to the view that maybe gold needs a bit of a pause in its rally or even a bit of give back. And it leads us to the view that within the equity market, the market's rotating away from tech. And at the moment, it's rotating a bit to defenses. But I think over the course of the next few months, it'll start rotating cyclical. So that's kind of how we're thinking about things. It's all about that key debate. More than ever, it's about that US macro debate. Where are we on that soft landing recession and reacceleration debate? So yeah, that's how we're thinking and talking to clients at the moment.
You know, with that in mind, you know, as we're thinking about some of the recent record highs, and that is the backdrop or the broader context that any investor who's waking up this morning trying to figure out, okay, is there still more room to run from here? What is your assessment? Because in your notes, you're saying that this is a technically concerning level right here.
Yeah, I think in the short term, we've kind of overdone it. I mean, we've just priced in a 50-bip cut. The markets loved that over the last 10 days, you know, as they're coming up to the meeting and after the meeting. We're back at the all-time highs on the S&P, as you say. And I think if I look at short-term market timing models, they're all basically on sell. So I'm a little bit cautious. Sentiment's very toppy. There was a survey out over the weekend that I think family offices are 97% bullish. I mean, you just don't get more bullish than that, really. So you got the same in retail, you got the same across many parts of this market. So everyone's kind of all in and positive because you got a 50 basis point cut in a sense. And that just makes me nervous in the near term. So I think technically this market's a little bit overcooked. So I'm a little bit cautious in the very near term. But if you look out 12 months, I think there's a lot of interesting prospects across the global equity market, actually, and particularly outside the US. But we're going to get that rotation, as I say, and I think that'll be good for a lot of the equity indices around the world and a lot of cyclical markets.
Chris Wadling, who's the founder and CEO and chief market strategist of Longview Economics. Thank you so much for taking the time here with us today. We appreciate it.
Thank you. Appreciate it.
Certainly. Intel shares climbing this morning after Apollo Global Management, parent company of Yahoo Finance, reportedly offered to make a multi-billion-dollar investment, according to Bloomberg. Now, this comes just days after a report revealed Qualcomm is exploring a takeover. Joining us now to weigh in is Stacey Rasgon, who is the Bernstein Managing Director and Senior Analyst here. Okay, Stacey, you got to give us your assessment here, especially as all eyes are on Intel this morning, both from an investment point and potentially from a takeover point as well.
Yeah. Let's talk about the potential takeover first. So there were some news stories at the very tail end of the day on Friday that indicated that Qualcomm might be thinking about making a bid for the company. So I don't know. Like, neither company has commented at this point. I guess we'll see. I will be honest. So we did some work on that. We published it this morning. I have a hard time seeing that deal work, especially if the fabs are included. And the issue is that they're losing a lot of money right now. And, it's a big deal. Qualcomm would probably have to use a lot of stock. If they did a stock deal, it's significantly dilutive for Qualcomm, could be 20% or even more dilutive. And the problem is if they start borrowing money and adding cash, the leverage goes up really, really high, really, really quickly. So I have a really hard time seeing it work with the fabs. I'm not sure that they could do a deal without the fabs, though, because I don't really think you can spin them off. They can't stand alone by themselves as their own company. They're losing billions of dollars a year, and they have one customer. I don't think anybody really wants to buy them and run them, and I don't think they can just scrap them. I don't think that that's politically viable at this point. So I guess we'll wait and see. We'll see if something comes out of this. But I will be honest. I'd rather not see Qualcomm do a deal like this. I think it's hard to do a deal where I think the risk would justify the returns on this. We'll see if they can construct something, but I don't really like it. So I'm hoping we don't have something like this.
Stacey, what about the interest from Apollo, the up to $5 billion investment interest? I guess you would look at that as that could be a sign that's encouraging, at least for Intel.
Yes and no. So they already have a relationship with Apollo. So they just sold half of their Ireland Fab 34, I think, to Apollo for $11 billion. They actually got that money last quarter. And in return, they have to load that fab preferentially. And they have to, they've effectively guaranteed Apollo a return on that. So they're paying them off of that. But they have a relationship already. So the story this morning said Apollo was potentially considering an equity-like investment, whatever that means, for up to $5 billion. Again, neither company has commented at this point. Obviously, I guess you could read it on the surface as like a vote of confidence, I suppose. However, I'm also kind of old and I'm kind of pessimistic. And I kind of feel like if you need help from the private equity companies, you're already in a bad place. That's usually not something that you would want to take if you didn't have to take it. They don't work for free. So I really do wonder, like, if they are considering something, like, why? Like, do they actually need it? My own personal opinion is that they're not desperate for cash. I don't think so. Given the OPEX cuts and the CAPEX cuts and the dividend suspension and the government subsidies, as well as the other private equity funds that they've gotten already for selling pieces of the fab to Apollo and also to Brookfield, I think that's enough cash. I don't think that they need any more. So I guess we'll have to see. But again, same thing. You don't really want to take private equity money, I think, if you don't have to take it. So.
All right, so Stacey, they're not desperate enough. You have questions about fabs, but then also just the regulatory side of things too. Going back to Qualcomm, I guess is that something that's almost could potentially stop this deal in its tracks?
Yeah, I think it's really tough. So, and by the way, like any semiconductor deal for anybody needs regulatory approval effectively everywhere because they all sell everywhere, and you need the U.S. and Europe, and in particular, you would need China. So we'll see about the U.S. if something like this happens. At least it would sort of be like a U.S. national champion buying a national champion. Maybe that makes it easier in the U.S., but I don't see any reason why China would go after this. I mean, a weaker Intel and a weaker U.S. semiconductor manufacturing base is probably a positive for China. And frankly, I also have flashbacks to the Qualcomm NXP deal. Your listeners may not remember, but Qualcomm tried to buy NXP back in, I think it was like 2018, 2019 kind of time frame. Mm-hmm. And that was the big problem. They got approval everywhere. There was no reason, like structure, that it shouldn't have got approved, but China did not approve it. And they actually didn't even turn it down. They just sat on it for almost 2 years, for 20 months, until they just couldn't wait any longer. And this was during the prior Trump administration. But even so, I wouldn't say that like relationships with China have gotten better since then. And so, yeah, I think China approval is a huge issue. I don't really know how they get around that.
Yeah, that acquisition attempt terminated back in 2018. Oh, yeah. A 2 years long process, essentially, here. Just lastly, while we have you here, Stacey, I was thinking as well what this might mean for a company in Mobileye. And I know that there are certain companies that are in your coverage within this deal and then those that are not. But Intel having a sizable stake with Mobileye, if they were to take an investment like this, how much pressure do you think they would face to really remove themselves from or trim even more of that stake?
Yeah, so there are very few areas where Qualcomm and Intel really overlap. That is one of them, right? So Qualcomm has a fairly sizable, compared to Mobileye at least, they have a decently sized automotive business. And there are only three companies that really have a full stack self-driving solution. It's Qualcomm, Mobileye, and NVIDIA, and so they do compete. Qualcomm, Mobileye. So yeah, Intel's already talked about. I mean, they have I can't remember. It's an 88% ownership in Mobileye. Yeah, they'd probably have to divest. They've already kind of talked about that. Eventually, they'll divest it. Probably. This is not a great time to do it. Mobileye's down a ton off of its peak. Mm-hmm. But yeah, presumably they would have to divest it. They've also got another piece of the business called Altera where they don't overlap. But Intel has already talked about IPOing that business at some point down the line. Hmm. So I don't know that any of those things would change. And in fact, they would bring in some cash that might help with the deal leverage. Although, again, my math suggests that even if they did it, it likely doesn't help the leverage position enough to de-risk it sufficiently, in my opinion.
All right, Stacey, always great to get your insight, especially on a morning like today. Stacey Raskin, Bernstein Managing Director and Senior Analyst. Thanks so much for taking the time to join us. Now let's take a look at how the market is moving less than 30 minutes ahead of the opening bell. We want to zero in on tech stocks. We saw some outperformance as a risk on trade gained some momentum at the end of last week. We have Jared Blickery standing by with a closer look at some of those moves. Jared.
Yeah, thank you, Shauna. Let's go to the Wi-Fi Interactive, which we have up here. This is what happened Friday, and this is in semiconductors. Let me just show you the 5-day look so we see what happened last week, because it was more bullish than bearish. Mobileye, recently talked about here, and Intel are the leaders in that, and we see ARM here down about 6%. Now, in software, let's take a look. We had a lot of green last week as well. CrowdStrike was up 15%, EA down 4%. But let's take a look at what's going on this year. And I'm going to compare software to semiconductors. This is year to date. And you can see in cyan here, we have software just slightly outperforming. But over the last month, it's clear that software is the leader here. It's positive, and the negative goes to the chip stocks here. So I also want to compare large cap tech to unprofitable tech. I think this is an interesting comparison because with all the rotation that we've seen into small caps, and a lot of those you're going to see in those ARK Innovation Fund tickers, that is the leader over the last month, slightly outperforming tech, which is negative over that time frame. Now, before we go, I got to hit crude oil. Crude oil looking a little bit bearish. Now, this is overnight, so it's still positive, but the bearishness comes from traders' bets. Every week, the CFTC, Commodity Futures Trading Commission, polls traders and see what their bets are, and it's very negative right now. In fact, the most bearish since 2011. Now, the story is OPEC Plus is going to be adding 180,000 barrels per day. They were going to do that in October, but now they're kicking that can down to 2025. But I've got a choice quote here from Javier Blas over at Bloomberg saying, OPEC Plus is like a tea bag. It only works in hot water. So to judge by its latest actions, OPEC Plus has yet to realize it's inside a warming kettle. So I take a look at this year-to-date chart in crude oil, which I'm going to pull up here. It looks like we're down by the lows. We went a little bit negative, but you take a look over the last 3 years, we just bounced off support. So I think the danger is an upside squeeze, and you can consider that a contrarian opinion.
All right, Jared, you win the award for quote of the morning so far. Jared Blickery, thanks so much for breaking that down for us. Well, stocks hitting record highs last week, pushing the S&P 500 up 1% for the month. Now, remember, historically, September is actually the index's worst performing month. So the next few days could be make or break for the market's recent momentum.
That's right. And first up, economic data. Plenty of it. Investors will get a fresh read on the Fed's dual mandate this week. The labor market with jobless claims on Thursday and inflation with the Fed's preferred PCE index out Friday morning.
Plus, Atlanta Fed President Raphael Bostic kicking off a busy week of Fed speak this morning. Tomorrow, we're going to hear from Fed Governor Michelle Bowman. Now, remember, she was the one who casted the lone dissenting vote at the Fed's September meeting, the first governor to do so since 2005.
That's right. And more economic commentary from the campaign trails. Former President Trump will deliver his remarks on tax proposals Tuesday, while Vice President Kamala Harris set to give a speech this week outlining her vision for the U.S. economy. There are less than 50 days until the election, with early voting already underway in some states.
All right, we'll keep right here on Yahoo Finance. Coming up, a look at some of the tickers trending pre-market. That's coming up after this break. We'll be right back on Morning Brief.
Now time for some of today's trending tickers. You can scan the QR code below to track some of the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Let's go first to Taiwan Semiconductor and Samsung reportedly in talks to build factory complexes in the United Arab Emirates, according to the Wall Street Journal. Top executives from Taiwan Semiconductor have visited the country and are in discussions to build a plant on par with some of those advanced facilities in Taiwan. And then additionally here, Samsung senior leaders visited the country and exploring a possibility of new chip making operations there. And so with that in mind, we're taking a look at both of these companies. I mean, the build outs of more factories and really to be able to scatter where they're, or at least diversify where they're able to get supply into different regions more readily. I think that's what some of the focus is right now in trying to make sure that they have more of these operations in international entities and nations that will welcome them at this juncture.
Yeah, it'll be interesting to see whether or not this actually comes to fruition, because they did reach out to the two companies for comment. This is the Wall Street Journal, and TSMC coming back saying that they are focused right now on the new facilities that they are currently already building, which is in the US, in Japan, and in Germany at the moment. So that is where the focus lies. We know that the Middle East has been vying to be a larger player within the chip space. When you come to some of the moves, some of the offers that they have made recently, of course, this includes potentially backing some of that plan that was laid out by OpenAI's Sam Altman to expand machinery and systems for the technology. We reported on that a few months ago. So they have been targeting the semiconductor industry here as a huge growth opportunity. They've been doing that now for several years. So going forward, they have struggled a bit just because this area of the Gulf does lack some of that infrastructure that is needed in order to attract these chip makers, just given the fact that it costs so much money, tens of billions of dollars that it takes to construct and also just equip these facilities to the standards that they would want. That has been one of the challenges here for the companies going forward. But again, the projects of the scale under consideration could reportedly cost more than $100 billion. That's according to the Journal.
Yeah, I mean, and one thing that people need to remember, and investors, especially as you're looking at where regionally they're trying to bring this to fruition, it's in the Silicon Oasis, which is Dubai or the UAE's big pitch for getting some of the companies most focused on cutting edge technology, whether that be in chips, whether that be in some of the digital infrastructure, R&D facilities, building out new technologies, robotics, and even autonomous vehicles out there. That's been the big pitch, and that's how they've been continuing to get some of these major partnerships, trying to bring them into that region as well. So we'll see what further comes from the Silicon Oasis and what goes into it as well.
And we'll be tracking. All right, let's move on to our second ticker of the day, and that is Microsoft shares. Ticking lower here this morning, getting a rare downgrade. Now, when you take a look at it, D.A. Davidson downgrading the tech giant to neutral. That was from buy. Maintaining, though, the company's price target, the firm saying competition in the AI space has caught up to Microsoft and its lead in the cloud and code generation business has diminished. I combined those two words there. So he's saying that some of the leadership there has diminished there for Microsoft moving forward, specifically some of that competition. He cites AWS now adding nearly as much cloud business as Azure going forward. He sees that as a headwind here just in terms of comp growth rates as Azure's last quarter. They're failing to impress when you compare it to maybe some of the other stronger growth rates within the industry, or I should say, I guess those that are picking up more momentum there going forward. Also went on to say just the proprietary hyperscaler semiconductor analysis showing that AWS and GCP far ahead than Microsoft in using their own chips in their data centers. He's saying that is going to give them a big advantage over Azure moving forward.
Yeah, I mean, this was really not even just the downgrade for Microsoft. It was a vote of confidence in Amazon and what AWS is being able to do. They also mentioned as well, talking about some of the data center capital expenditures increasing from 12% of revenue to 21% of revenue here. That is a higher rate of increase, they note, compared to some of those competitors, Amazon and Google. And that's a result of Microsoft's greater reliance on NVIDIA, they say as well here.
And we have more on the downgrade in our show Catalyst here. We're going to be speaking with Gil Loria. He is D.A. Davidson's managing director on his call to downgrade Microsoft. That's coming up next hour in the 10 a.m. Eastern Time hour. You won't want to miss that. Let's take a look at Palantir. Shares are in the red. Raymond James downgrading the tech company to market perform from outperform and removing its $30 price target. The firm saying that it's time for the stock to consolidate its gains and adjust to its current valuation. Now, despite that downgrade, the firm's still largely optimistic about the company's long-term AI positioning. So going forward, they're basically just calling into question just their rich valuation, saying that it leaves very little room for error at this point, given the stock's very strong recent performance. He also went on to say that, quote, making it the richest software name amongst the comps there at just around 26 times, fiscal year 2025 sales. So again, just that rich valuation is what is being called into question.
Yeah, recently newly added to the S&P 500 for Palantir, so there's more exposure that investors who are opted in or have invested into the S&P 500 over the years. If you're still holding that, you're holding some Palantir now. So that's in addition with what is essentially really, to your point, and as we were mentioning just a moment ago, it's really just a valuation call, talking about how well the company has done to this point. We'll see if we can get a populated stock chart on there, but taking a look at PLTR shares over the course of this year, one of the things that anybody who's been tracking this over the course of 2024 will remember and note, it's up more than 124%, so far exceeding the market gains that we've seen on a broad basis here and leading the pack in many regards. So valuation call added to the S&P 500. Really still not too much to be concerned about at this juncture.
All right, well, and on a programming note, are you on the hunt for the hottest market commentary? You're going to want to watch Opening Bid with Yahoo Finance's executive editor, Brian Sazi, for unrivaled insights from top analysts, also direct lines to the biggest power brokers in the business. Tune in every Monday, Wednesday, and Friday at 8:30 a.m. Eastern Time. Well, coming up next, we've got the opening bell on Wall Street. Stay tuned. We'll be right back.
We're just seconds away from the opening bell on Wall Street. Taking a look at the Dow, the S&P 500, and the Nasdaq futures. We're holding on to green across the board as of right now as we're set for that opening cross here. Let's take a look at the opening bell at the NYSE and the Nasdaq, where you've got two great bell ringers on both sides. You've got at the NYSE, it looks like you have some dignitaries ringing the opening bell. And then additionally, you also have at the NASDAQ the Building the Future Summit. New System Ventures ringing the opening bell there. And just like that, we are off into the races on this, a new trading week and I believe the last full trading week of September as well here. So a lot to keep close tabs on here. We got some economic data, we got some Fed speak, we've got some earnings, we've got all of it for you here. But first, we had the opening bell. Let's take a look at the S&P 500 as we're taking a look at some gains right now, and we'll put this on why don't we put this on a 1 month view just to let you know how things have been faring. And it's been a volatile one. However, we're back in the green, and that's a good thing. The S&P 500 seeing some new record highs last week. We'll see if we can continue to power to and through and stay in that ballpark as well. The Nasdaq Composite, as of right now, you're seeing that hold on to gains. We're above 18,000 to kick off this trading week. And then additionally, taking a look at the Dow Jones Industrial Average, hyper waffling, if you will, trying to figure out its mind, make up its mind this morning, oscillating between gains and losses, the Dow is. But let's take a look at some of the sector activity. As we're taking a look at these 11 S&P 500 sectors, you'll note that we are a little mixed right now. Staples pulling up the caboose. That's down by about 0.2%. However, XLRE, that's your real estate select sector, spider fund, well, XLRE, the real estate sector, you're seeing that higher by about 0.9%. More gainers than laggers, and for much more on today's early trade and what's playing out in the tape, let's go to Yahoo Finance's Jared Blickery for a look at what's moving. Hey, Jared.
Thank you, Brad. I'm just watching stocks open higher, although the Dow just tipped into the red. Let me put a 2-day view. You can see right there. But the Nasdaq up 0.3%, S&P 500 up 18 basis points, a little bit less. And the Russell 2000, well, this is actually slightly delayed quote. So we don't have that open, or we don't have that quote just yet. But in the pre-market, the Russell 2000 futures were the leader. And they're just coming, they just snapped a 7-day winning streak, I believe, last week. So interesting to see them give a little bit back. And Brad just went over the sector leaders. So I'm going to get to my other leaders. And here we have, look at this. We got chip stocks. We got Chinese stocks, Bitcoin, Mag 7. We also have, looks like it's just a broad swath of bullishness right here. And let me pull up home builders, because we've seen these home builders really just take off lately, thanks to the anticipation and then the fulfillment of lower interest rates. And so that's what's behind that play right there. Let's take a look at Bitcoin as well, because Bitcoin is jumping. And let's see if I can find my crypto screen. There we go. It's up 1% or 87 basis points over the last 24 hours. But you'll notice in this year-to-date chart, it's just been drifting lower for a very long time and kind of been bouncing off the lower end of the channel and then bouncing down from the upper end of the channel. So it's just been doing that. It's been in a holding pattern, but traders looking for the next catalyst, and not exactly sure where that's going to come from. I want to close here on Chinese stocks. We've seen those under a lot of pressure, but not today. We have XPeng and NIO, so some of those are in the red. So some of those automotive EV tickers looking a little weak, but here's Alibaba up 1.83%, Pinduoduo up 71 basis points, JD up 2%. Let me just check out the year-to-date. Yeah, more bearish than bullish, guys.
All right, Jared, thanks so much for breaking that down for us here. Our next guest saying that the post-Fed trade marking a crucial moment for equity market positioning going forward. What sectors should investors be targeting, and is there a rotation underway that's going to last? We want to bring in Peter Garner. He is Saxo Bank, a chief global equity strategist. So Peter, answer the question for us. We've been talking a lot about this rotation trade. Now the fact that the Fed has cut by 50 basis points, maybe we're going to see small caps and mid caps catch a bid. What do you think? Is there more upside, and what does that upside look like?
Yeah, I think we're coming off a very high equity index concentration with the Magnificent Seven, et cetera, in that top of the pile and the S&P 500 controlling the market. I think we are at a tipping point where a trajectory with lower interest rates will lift all boats in the U.S. equity market. So I think we'll begin to see the broader market beginning to outperform relative to the mega caps. So I think we're not afraid of this interest rate trajectory going lower. If we look at the past 20 rate cycles that have been since 1957, you can see that only 3 paths led to a negative return in the subsequent 2 years, and that was the 73 rate cycle, 2000 and 2007. All the other paths led to a positive return, and actually the median path was actually quite positive. So, of course, you need the context, but we think the U.S. recession probability is still low. So we're quite constructive, and we think it's an opportunity for investors to look at, do you have the right components in a cycle where policy rates are slowly drifting lower. You mentioned real estate is having a good day today. I think we will continue to see this rotation into some of the more positive, sensitive sectors to interest rates. Home builders is another one that is doing quite well.
You also mentioned consumer discretionary could be one of the areas that people adjust their portfolios to. Why do you think that is, especially if we were to see more potential deterioration economically that would lead the Fed to cut even more?
Yeah, so I think that our base case scenario is that the interest rate path that we're seeing right now from the Fed is they're adjusting the level according to the inflation, not because we're rolling into a recession. So if we get that type of scenario with a soft landing and lower interest rates, that should be positive consumer discretionary. We can see in the US consumption patterns that overall consumption is actually doing okay at the aggregate level, but it's really particularly the big consumer items that are being holding back. And that's obviously tied to interest rates. We see that with the car industry. So that's one of the sectors that we think could come back into favor as we go forward from here.
Peter, why do you see the recession risk as very low or still very low at this point?
Yeah, so I mean, you can track an economy across a wide range of indicators. And what I've been saying for many years is that we have had a very unusual cycle since the pandemic. And you can pick 10 indicators very quickly that show you that, oh, we're going into a recession. But I can very quickly also show you and find 10 indicators that are showing things are going okay. We really like the high frequency, the weekly series that is really a real-time estimate of where US GDP growth is right now. And the US economy is growing very closely to trend growth, so around 2% GDP. Wages are still looking okay. The labor market has stabilized if you look at the weekly series from Indeed job postings. So we're not really seeing that we're rolling over a cliff here and moving into a recession. I think a lot of what is happening is that the interest rate cycle that played out in 2000 and 2007 is so recent that they are still impacting a lot of investors' judgments about what this rate cycle means. And we think that's misguided if you look at the more longer term perspective. Rate cycles are not negative, rate cut cycles, I should say, are not necessarily that negative, and we're not seeing a recession. But of course, we can be wrong, but we put the probability still in the low end over the next year at maximum at 25%.
Peter, during past cutting cycles, technology has been one of the sectors that typically tends to be a beneficiary, but it feels like there's already been so much overexuberance in this AI thematic trade that's benefited tech more broadly here. Do you think that can still be an outperformer and kind of mirror or at least rhyme with the past, despite the run-up?
Yeah, I don't think technology widely will be a huge underperformer. We just think that there are segments of the US equity market that have been lacking, and that's also why the index concentration has been rising. But I don't think the technologies sector will be a catastrophe per se. We actually do have like communication services, which include companies like Netflix and Google and Meta. We still have that sector as one of the better ones when you look at it from a combined perspective of valuation and the growth outlook. So I don't think technology at all is bad. We still have a cycle going on with NVIDIA and NVIDIA coming out with the Blackwell chip. We do think there will be another investment wave in this. AI will carry a lot of investments. And this has been one of our core tenets. I mean, as an argument against why we don't see things being so negative at others, is that if you actually look at the healthcare, the communication services, and the information technology sectors, those three, which are some of the largest components of the equity market. If you look at their R&D and CapEx, combine those two, we do actually have an investment boom in the US across those three sectors. And that's a very powerful force that we think will continue until we get to a recession, but that we don't see that coming just around the corner just yet.
Peter, one thing we haven't talked about is the election, and we've heard from a couple of strategists, a couple of economists, mainly strategists, that this could be a risk here for the equity markets, at least in the short term, just given some of that uncertainty. Are you at all positioning around that, or how closely are you tracking the election in terms of ultimately the impact it's going to have on the equity markets?
We are, of course, tracking the US election as one of the most important events in recent memory, not at least because of what the impact will be on geopolitics, depending on who wins the election. But there are different scenarios, and one of the potential negative scenarios, and we will not try to guess too much ahead of the election, but of course, our economic outlook for the US will change depending on the outcome. And one scenario that could play out is that Harris wins the U.S. presidential election, but the Democrats fail to control the U.S. Congress. In that scenario, you have a gridlock situation, which most likely could lead to a negative fiscal impulse cycle for the U.S. economy in 2025, making it very difficult for the Democrats to really continue with this massive fiscal spending that we're seeing. If we get into that scenario, then obviously we have to tweak our scenario for the U.S. economy. But let's just take one thing at a time. But it's certainly one of those scenarios that we have to take into account when we get there.
Peter Vonry, who is at Saxo Bank, joining us here this morning. Thanks so much for the time, Peter. Appreciate it.
Thank you.
Certainly. Guys, coming up, gold has been on a tear, but are there risks ahead? We speak to an analyst on what's next for the precious metal. That's coming up on Morning Brief.
Gold hovering near record highs ahead of PMI data out later this morning. The precious metal reaching those all-time highs following the Fed's 50 basis point cut last week. To discuss whether or not we're headed higher or if there are risks ahead that investors should keep in mind for gold, we want to bring in James Steele. He's HSBC's Chief Precious Metals Analyst. It's great to have you, James. Let's talk about where we're trading right now. We have gold right above that 2,600 level. Is there much more room to the upside, or are we likely going to see a pullback from these levels?
Well, I think we're going to see increasing resistance up here. There's a couple of things that would imply that the market is going to run into some resistance. One is that jewelry underlying physical demand is down. Jewelry is down. 50% of all physical demand for gold is in jewelry. Most of that is in the non-OECD world. That demand is slowing because of high prices. They're very price elastic. Coin and bar demand is slowing as well. Now, the problem is that these changes in the physical demand will often take a very long time to push into prices, because right now we have a lot of momentum buying in the market and a lot of technical buying, and a lot of it predicated off of expectations of more rate cuts. So near term, sure, we probably have a little bit more upside, but we're a little suspicious of it above $2,600. That's not to say that we can't move a little higher in the near term, but there are some roadblocks ahead.
How much of that is predicated in gold going higher from these levels, predicated on the Fed aggressively cutting or continuing to cut?
Yes, I think that's right. And these cuts have been well telegraphed. I mean, gold does have a history of rallying during Fed rate cutting cycles, but much will depend on how much of this is baked into the price already. And certainly after the 50 basis point cut, perhaps we won't see a cuts quite that aggressive. We're forecasting a series of 25 basis point cuts going forward. And we'll have to see what Fed speakers are going to say to imply one way or the other. But some moderation in the rate cutting cycle would tend to remove some oxygen from the gold market. You're absolutely right.
Sorry, James, can you just repeat that? What did you say was your base case or your expectation for the Fed's next move?
25 basis points for the next two this year and and into next year.
Okay, so 50 total before the end of the year, which makes a lot of sense. And that is, largely speaking, I guess, what some market participants are pricing in. I'm curious what you make just about this entire debate, whether or not we're going to get 50 or 25 at this next meeting, and exactly what that means for the price of gold and just precious metals beyond that, just given the fact that there is so much uncertainty, and a lot of that is already being priced into some of this lead-up trade that we've seen.
Yes, well, we're looking for, as I say, 25 basis points for the next, for the meetings for the end of this year. That's probably mostly baked into the price now. A lot will depend on how the dollar reacts. We're sort of looking for a somewhat firmer dollar, not simply because the Fed is cutting, which would tend to be negative for the dollar, but because other central banks are also going to cut. And also that the US economy, as your previous speaker said, is doing well. So by comparison, the US is doing quite well. If this firms the dollar, which we anticipate that it will, then that would be a negative on gold, and that would restrain further rallies.
But with that in mind, you're also watching some of the central bank actions that, as they're initiating or thinking about cutting, and that policy pathway there, they're also looking at where they might be purchasing into some of these precious metals and gold specifically. What type of buying power or buying proponent do you believe they'll continue to be and bolster the price action we've seen thus far?
That's an excellent question. And you've hit one on one of the really seismic changes in the gold market in the past few years. In 2022, central banks bought 1,082 tons of gold. Last year, they bought about 1,030 tons of gold. Now, this is more than double the average of the previous 10 years, which is $400, $450. So you can imagine this has absorbed a great deal of demand. Now, in the first half of this year, they've been pretty strong, over 400 tons, 480 odd, I think. Second half, I mean, we're looking for these high prices to curb official sector demand as well. It doesn't mean that they're not still on a long-term buying program, and we believe there's very good reasons that a central bank would want to own more gold. But they will also be price sensitive, and we are at very high prices. And if they're playing a long game, they don't have to rush into the market. So I think we're probably likely to see them moderate purchases in the second half of the year, which may also create a little bit of headwind for gold.
James Steele, HSBC Chief Precious Metals Analyst. Thank you so much for taking the time here with us this morning.
Thank you very much.
Certainly. Hey everyone, it's time for our chart of the day. After a 75% rally to start the year, That brought Bitcoin to nearly $75,000. The cryptocurrency came off of those highs and is now in a holding pattern. Could the next big catalyst for the digital currency be the election? History might just have something to say about this. Yahoo Finance Catalyst co-anchor Madison Mills over at The Interactive with a further look into the crypto space. Hey, Maddie.
Hey, Brad, thanks so much. So I want to take a look at how Bitcoin has performed both in 2016 and 2020, those prior election years. You can see this light blue line is the performance in 2020, a clear kind of hockey stick following the November election. And by the way, this bottom axis here, you can see the day of the year. So pretty far into the year in 2020 is when we did see that Bitcoin rally following the results of that November election. Also, you can see this purple bar is 2016, a slight rally after the election, but nothing like what we saw in 2020. And then this yellow line is where we are now. So we are in a bit of a holding pattern, like you mentioned, Brad, for cryptocurrency, specifically for Bitcoin. So the big question is whether or not the election could lead to a little bit more of a rally in Bitcoin. And this has kind of become a political football between both of the presidential candidates. We had Vice President Kamala Harris over the weekend and in the recent days here talking about what her potential policies could look like, kind of pinning herself as a pro-digital assets candidate. This comes as former President Donald Trump has done the same thing, right? And I want to point out a note that I was looking at this morning from Standard Chartered's head of digital assets saying that his belief is that Bitcoin could rally to $125,000 by year end if former President Trump does secure a win. Of course, right now, Bitcoin coming off its $75,000 highs and trading in a little bit of a range-bound range here because of a lack of catalyst for the sector. The thing I want to leave you guys with is that what's different this time around versus what we saw in that prior chart is that Bitcoin was previously coming off of lows within a bull rally. So you can see that there was a big dip prior to the rally. And right now, we're not necessarily seeing that. If you go all the way over here, you see the lows of the year for Bitcoin. So it's less of a potential likelihood for a huge jump up, given that Bitcoin has not been in as bad of a place heading into this election.
All right, Maddie, thanks so much for breaking that down for us. Also something for us to keep in mind and keep an eye on here throughout the next couple of trading weeks. All your markets action ahead. Stay tuned. You're watching Morning Brief.
We're taking a closer look at Yahoo Finance's trending tickers. 3 names that you need to watch this morning. We've got General Motors, Nike, and Alaska Airlines, and we're doing it in less than 30 seconds each. Let's go. First up, General Motors getting a downgrade from Bernstein to market perform from outperform. on rising earnings headwinds. There you're taking a look at shares. They are down right now by about 3.25% here. They say that their data signals rising earnings headwinds. We think there's a risk the company will announce additional capital requirements during its October CMD. That coming from the analysts at Bernstein. And so ultimately being concerned about that. The CMD, I should say, is the Capital Markets Day, just to define it for everybody out there.
And I was wondering, but I wasn't going to call you out just in case.
Ooh,
Never
got
know.
you
But
covered.
you got it, always. All right, let's take a look at Nike. It was placed on JP Morgan's negative catalyst watch ahead of its earnings report on October 1st. The analysts there talking about some checks that he's done and also commentary from executives warning about headwinds across geography. So just to break it down quickly, in North America, he cited some challenges within Nike factory stores, a lot of that being related to weaker low-income consumer. In China, talking about the fact that he actually sees results coming in below the plan right now, talking about weakness in July and August. Also the fact that the bump that's typically seen thanks to the Olympics, saying that that did not materialize this year.
Yeah. All right, let's go to the skies here for a hot second. Finally, Alaska Airlines trying to get back on track after an IT outage caused disruptions. A ground stop was in place in Seattle for about 2 hours. The airline said in a statement that the outage was not caused by a cyber attack. There are worse airports to get stuck in. Seattle is a great one to be stuck in. But anyway, as you're taking a look at the shares here year to date, it's been a bumpy ride here, a little bit of turbulence for the company. However, still net positive by about 3.6%. They said during a tweet or a post, they're experiencing a significant IT outage when they had first reported this, and it seems like the issues have been resolved as quickly as possible.
Doesn't matter how nice the airport is. You're always
You don't
annoyed.
want to get stuck.
You're always annoyed if you're stuck. Or at least I should say I'm always annoyed.
I'm quite
when I'm
lax.
stuck or delayed. Yeah, you know, that also fully describes our personalities, I think, to a T as well. All right, well, coming up, we just got a fresh read on the economy. We'll dive into the latest in the services sector and what it could signal for the Fed's path forward next on Catalysts. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the trading day, we've got three catalysts for you that's moving the markets: weakening services data, the outlook for tech stocks, and also Lina Khan defending her trust-busting record.
Fresh economic data showing the services sector weakening slightly in August, still coming in above expectations for the month, though. And this comes as Fed Chair Jay Powell expected to speak on Thursday for the first time since the central bank's larger than expected rate cut. Will markets get the clarity this week that they're looking for on the Fed's path to neutral? We'll discuss.
And the everything rally appears to be back with tech leading the gains, but the Mag 7, it isn't moving as a unified block. We're going to speak with one analyst talking about why he's bullish on Amazon and maintaining an outperform on Alphabet despite some of those regulatory concerns.
And the head of the FTC, Lina Khan, defending her trust-busting policies in an interview with 60 Minutes. How could a Trump or Harris presidency affect regulatory moves moving forward? We'll talk about that later as well.
But first, we have fresh data for manufacturing and services sector from S&P Global. U.S. manufacturing coming in at 47. Economists were expecting 48.6. U.S. services 55.4. Economists were expecting 55.2. Slightly ahead of expectations, but below the prior month's reading, which was just around 55.7. Taking a look at some of the reasons to maybe take a slight issue here with this report. PMI showing the highest input prices that we have seen in just about a year. When you take a look at some of those output prices, 54.7 from 52.9. That was at their highest level since March. So again, we're seeing a bit of reaction here. We've got yields pulling back just a bit on this report, but again, not a huge movement one way or another.
Yeah, it's interesting because it is indicative of a broader question mark about the potential of reinflationary pressures because of the input prices coming in at 59.1 above that 57.8 level. Having said that, just mentioning some superlatives from this, we had the weakest manufacturing PMI numbers here since June of 2023 and the weakest services data since July of 2024. So while that headline number did come in above expectations, it's still below the prior month. Taking a look at the market action, though, the market holding on to a little bit of a upward trajectory here for the day. The S&P up about 0.2% and the Nasdaq up 0.3%. Just a quick look at the Treasury space. Yields did dip initially after that PMI data came out. I want to just see how we're looking, though. Right now, you can see the 5-year, 10-year, and 30-year on your screen. Looks like some recovery in yields across the board there after that data. Let's take a deeper dive into what today's services data signals about the broader economy with Veronica Clark. She's an economist from Citi. Veronica, thank you so much for being here with us this morning. Just starting on this PMI data that's just crossing now, anything that you want to raise an eyebrow at?
Yeah, I don't think we can learn too much new from this data. The services measure has been remarkably steady for the last 4 or 5 months or so. Some of the details there are a bit more interesting, though. The employment subcomponent, that's still below 50. That's still in contractionary territory. And of course, it's really employment data that matters, first and foremost right now. Manufacturing, that definitely was weaker than expected. It does seem like manufacturing activity is really pulling back. Of course, we saw job losses in that sector in August, so that does seem to be slowing more dramatically.
Veronica, what's your base case at this point? After the Fed cut by 50 basis points, what are you expecting between now and year end? And how are you factoring in that risk of recession?
Yeah, I mean, I think that risk is still pretty elevated. It really just comes down to the trends that we're seeing in the labor market. We do think this is a genuine weakening of the labor market, and we can see that more in data that we're going to get next Friday. We'll have another jobs report before we get to that November decision also. But I think both of those should show this weakening trend continuing, and the Fed is cutting 50 basis points again in November in our base case. Maybe then slowing back to 25s thereafter, but the risk is that they would be front loading even more of this.
I'm interested in that because in your note you talked about how your base case is for 50 at the next meeting, but they could potentially go even larger. How bad would the labor market data have to be to get 75 basis points of cuts come November?
Yeah, I think if we do see evidence of this more sharp weakening, which is kind of the point in historical cycles when you would start to see that. The bar is probably pretty low to front load even more of these cuts. By most measures of an estimated neutral rate, we're still very far from that right now, even after 50 basis points last week. So you do want to get more quickly back to neutral, not getting to neutral many months from now.
Veronica, is there any reason to be concerned that maybe the Fed is getting a little too aggressive? If they were to cut by an additional 75 basis points between now and year end, of course, that weighs the risk that maybe we could actually see inflationary pressures return here to the upside. How closely are you watching that, or why are you then not concerned maybe about that risk?
Yeah, I mean, of course, it's important to watch. Where you would expect to see any re-emerging signs of inflationary pressures first would be in something like the housing market. If we see home prices picking up or rents picking up, we don't have great timely data on that yet, but we do have data on weekly mortgage applications that are being filed for home purchases. And of course, we have seen mortgage rates coming down, but those mortgage applications still look very low. I think what could be happening is that the labor market is weakening, and that's going to offset any boost you would get from lower rates in that sector. So definitely watching it, of course, but the next 6 to 9 months to a year, the inflationary pressures look pretty muted, at least for now.
Yeah, Veronica, I'm glad that you bring up home pricing, because I was looking at some data this morning. The home price to median household income ratio now landing at 7.2 times. That is a new all-time high. Could the housing market end up being the Fed's Achilles heel?
Yeah, I mean, I do think you could see some re-emerging inflation risk there, not necessarily in the very near term, but maybe a year or two down the line. It is something to watch, of course. We are maybe structurally short housing still, so that could be a re-emerging source of inflationary pressure. But in the next year or so, 9 months, I think the overwhelming issue is going to be a weakening labor market.
All right, Veronica Clark, always great to talk to you. Thanks so much for joining us here this morning as economist with the Citi. The Biden administration is proposing a ban on Chinese and Russian car parts. Now, Commerce Secretary Gina Raimondo saying that this is a national security action and not about trade, which is an important distinction, just the escalation here in tension between the nations. But just ultimately in terms of what this could mean here going forward, they went on to say that this aims to secure vehicles which can communicate externally. And we're talking about communication through Wi-Fi, through Bluetooth, through cellular and satellite systems, a feature that's increasingly more and more common in these newer vehicles. So they're doing everything they can in order to try to confront or, I guess, minimize any of those national security risks. On a call with reporters earlier today, she went on to stress that that's U.S. Commerce Secretary Gina Raimondo. She also went on to say we are focused on national security threat, a very real threat that connected vehicles pose to our country and the American people. We're seeing some reflection here on stocks this morning in regards to this sector and some stocks that are under pressure. But again, lots of questions about what exactly this ban will look like in detail, and then, of course, a timeline of that.
Yeah, and it's interesting, given that we are so close to the election, this could potentially be the last blow to China from the Biden administration. And this comes after a slew of other ones, right? We know that the Biden administration has been pressuring Chinese electric vehicles with several policies that we have talked about as sort of kind of preliminary in nature, because there aren't really Chinese EVs on the ground here in the U.S., but they are meant to be preventative is the word that I was looking for. Also want to mention some other policies that this follows. Remember that ban on Huawei telecommunications equipment and investigations into Chinese-made cranes at American airports. Also, of course, the ongoing discussion about a potential TikTok ban, or at least ByteDance selling off TikTok. Several instances in which the U.S. government is looking to kind of close off and lead to a wall with regards to China, given some questions about cybersecurity issues to come. Certainly something we'll continue to monitor. Also want to mention Chinese stocks did end the day higher as traders are pricing in more stimulus to come. Chinese officials announcing a press conference to come on Tuesday addressing the health of the world's largest economy. The People's Bank of China also lowering its 14-day lending rate. And the last time that Chinese officials from the central bank announced an emergency meeting like this, they did announce a continuation of contraction in that lending rate. So that's something that we can potentially look forward to tomorrow. However, I do want to mention the context here. China has an annual growth target of about 5%. They've had a slew of data in August indicating that they are way offsides of reaching that target. And I do want to point out one stat I looked at this morning, $18 trillion coming out of the wealth from households in China, just given the real estate crisis. The government has been working in terms of fiscal policy to try and beef up the real estate market, but that has not come to fruition so far. And guys, this doesn't just impact China's economy. It also impacts, of course, a lot of those stocks we talk about all the time that have a lot of exposure to China and are counting on growth coming out of China as well.
And I think that's a big takeaway when we talk about what exactly this could mean here for our viewers, for so many investors here involved in the U.S. economy, in the U.S. stock market here, and ultimately whether or not, if we do see further involvement over in China, what that's going to do to stimulate their economy, and then ultimately how that growth will then trickle through, and we could see it it as a ripple effect across the world. Obviously, U.S. markets could potentially get a boost just depending on how exactly this all plays out, because we have heard time and time again from so many of our guests here over the last several months and really over the last several quarters just about the ongoing weakness in China, how that is weighing on so many U.S. multinational companies which rely on a strong demand in China. That has been a huge headwind here over the last several quarters. So anything done to stimulate that economy, therefore boost some of that lagging domestic spending that's happening within China, could then, of course, be an ultimate boost here for so many companies here in the U.S. as well, with large exposure in China. All right, coming up, FTC Chair Lina Khan defending her trust-busting record in an interview with 60 Minutes. We're going to discuss what a new administration will mean for her antitrust efforts next.
In the technology markets, we went through a couple of decades where we saw over 800 acquisitions by the 5 big players, not a single one of which was blocked. And some of those, we realized, ended up leading to significant harm. We've identified not just one merger, but a whole string of mergers that some of these large companies made that we believe were illegal.
That was Lina Khan, chair of the Federal Trade Commission, defending her aggressive antitrust agenda on Sunday's episode of 60 Minutes. Khan's term is set to end on September 26, though she'd stay on until a successor is named. With more on what a Trump-Harris presidency could mean for the future of the FTC, we're joined by Yahoo Finance Washington correspondent Ben Werschel. Ben, thanks so much for joining us here. So I'm curious what your biggest takeaways were from Lina Khan, really kind of defending her record in that interview.
Yeah, I mean, that's my takeaway as well. This is kind of a PR offensive from Lena Khan to comes up a lot. She comes up with donors. And so this is an attempt, one prong of an attempt to sort of show her work. You played the tech clip. She also talked about really voter popular things like the price of asthma inhalers and grocery prices. So this is a part of it. What it means for the future is very much to be determined. You know, I don't expect it's going to change a lot of minds in Trump world. Trump is very much expected to put her out of a job if he wins. Harris is much more of a question mark. Harris, her record has been a little more conciliatory towards tech over her career, but she hasn't said one way or another, and she's got donors who are telling her that to also replace Lena Khan. So that's one of the big question marks is sort of what happens with the Harris victory. One overall point I'd make is that there is a lot of skepticism of big tech on both sides of the aisle. That's going to be true no matter who wins. You know, it's been noted a lot that one of Khan's defenders is, at least before the summer, was JD Vance, who liked her taking an aggressive approach to big tech. So that's going to continue no matter what. But the shape of it, as you know, is very much up in the air.
All right, Ben, we also had some developments late yesterday down from Capitol Hill. An agreement reached over the weekend by congressional lawmakers on a deal to potentially avert a government shutdown. Just give us the details on that and then the next steps, because it's going to be another busy week in Washington.
Yeah, for sure. So Congress had kind of one thing it had to do before the election, and there was a lot of weeks of brinkmanship, but it looks like they have a deal to figure it out. The details are this is a 20-page bill to avert a government shutdown, which would happen next week if government doesn't act at the start of the new fiscal year. What the bill would do is extend it for about 3 months till December 20th. So people making holiday plans aren't excited about that because it's going to fall right at the Christmas season, but it will keep it through the election, and so that then the Congress will have to deal with it. It has a few small provisions, $235 million for the Secret Service, a reflection of a lot of the activity we've seen in the last few months. But it doesn't have any of the bigger ticket items that Speaker Mike Johnson had aimed to have in. He wanted to have a bill that they touted for election integrity. That's gone. They wanted to keep the government open to next year. That's all gone too. So it's kind of a predictable end of this story, and they'll start to vote on it Wednesday. And then the questions are, what are the repercussions? Trump has said he wanted a shutdown. He wanted this bill in no way, shape, or form. So does he continue that? Johnson's going to have to pass this, but with Democratic votes. So that could be dicey for him. But it seems like we're pretty well set to avoid a shutdown, and then we sort of push everything to December.
See whether or not he is able to secure the votes. All right, Ben, great stuff. Yeah. Thanks so much.
Thanks all.
Fed officials speaking out this week following the bank's 50 basis point rate cut. We already heard from Atlanta Fed President Raphael Bostic and Minneapolis Fed President Neel Kashkari earlier this morning. Now, Chicago Fed President Austin Goolsbee, he is speaking right now in an annual conference for the National Association of State Treasurers. Our very own Jennifer Schomburger is listening in and has the latest. Hey, Jen.
Good morning. That's right. Chicago Fed President Austin Goolsbee speaking right now says it's appropriate to focus more on the job market rather than inflation. And if the Fed wants to avoid a recession, then we can't get behind the curve. Goolsbee saying, quote, given the through line on economic conditions, that likely means many more rate cuts over the next year. He went on to say, knowing that labor markets tend to deteriorate quickly when they turn and that monetary policy takes time to act, it's just not realistic to wait until problems show up. He says rates need to come down, quote, significantly going forward if the Fed is to retain the economy and the job market where they are right now. Now, elsewhere, Atlanta Fed President Raphael Bostic and Minneapolis Fed President Neel Kashkari both said this morning they were in favor of voting for a 50 basis point rate cut at the last policy meeting as progress has continued down on inflation and as the job market has cooled. Still, Bostic explained that cutting by 50 instead of 25 was a close call for him because he feels the Fed has not declared victory yet on inflation, but it was the cooling job market that really got him to go 50. And it's Bostic's lingering concern about inflation not yet back to the Fed's 2% target that's keeping him from cutting in larger increments. But Kashkari doesn't see much evidence inflation might surprise to the upside and says he still thinks interest rates are too high. He's just uncertain at this point just how tight monetary policy is, given mixed signals for the underlying economy. Guys?
All right, Jen, thanks so much for bringing us the latest on that. Of course, a long lineup of Fed speakers this week, and I know you are going to be very busy, so we look forward to continuing updates here from you this week.
Thanks.
Now time for today's trending tickers. You can scan the QR code below and track the best and the worst performing stocks of the session with Yahoo Finance's trending tickers page. So let's get to it. First, we want to take a look at Microsoft. Shares are ticking lower here this morning. You're looking at losses of just about 0.1%. The move lower coming on the heels of a downgrade. We've got the analyst behind that call downgrading Microsoft today, saying that competition in the AI space is catching up to Microsoft's lead. Here to discuss that and more, I want to bring in Gil Loria. He is D.A. Davidson's managing director. And Gil, it's great to have you here. Clearly, it's having an impact here on the stock in early trading. I'm curious, just why do you see Microsoft's AI lead diminishing?
Well, they had a big head start because they were involved with OpenAI for a long time. They knew ChatGPT was coming before everybody else. They knew that they were going to commercialize it. So about a year and a half ago, they came out with a whole set of commercial products around AI that gave them a big lead over Amazon and Google, who were both caught flat-footed. Since then, Amazon and Google, AWS and GCP respectively, have invested in catching up to Microsoft. And we think that you can start telling that they've caught up, both in terms of the results they've reported and the conversations we're having with industry participants tell us that their capabilities are now comparable to Azure's, thus diminishing the lead. Going forward, we think they actually, AWS and GCP actually have an advantage over Azure because they have the capability to deploy their own chips into their data centers, which are a fraction of the cost of an NVIDIA GPU, something that Microsoft has yet to do with its own chips.
So, Gil, does that mean that the chips race is the forefront of this debate between which tech firm is going to come out on top versus which large language model is going to become most useful to everyday consumers? Obviously, Microsoft is attached to OpenAI and ChatGPT, but a lot of analysts have argued that Amazon is behind when it comes to its own LLM.
So both fronts are very important. And Amazon's approach is that they don't have their own LLM. They don't depend on their own LLM. They've created a system where you can work with any one of the frontier models, whether Anthropic, Mistral, Meta's Llama, and therefore they just support the rest of the ecosystem. That's what their customers want, and their customers don't want to be locked into one technology in one frontier model. And so that works for them. They don't have to have a model as advanced as OpenAI in order to be able to serve their customers, which is what's really key here. A year and a half ago, their customers were going to Azure to get AI tools. Now they don't need to. They can keep their customers and provide them with whatever those customers need.
So then, Gil, how reliant is Microsoft then on a name like NVIDIA? I guess we were trying to figure out just the importance there and exactly what that means for some of that momentum going forward.
Well, that's exactly it. Microsoft is so reliant on NVIDIA that it's almost transferring wealth from its own shareholders to NVIDIA's shareholders. Their overinvestment right now creates a point of margin headwind every year they overinvest, meaning Microsoft has to lay off 10,000 people just to keep its margins flat because of how much it's overinvesting in building this infrastructure using the most expensive chips, which are NVIDIA GPUs.
And given that, too, I'm curious how much, and you talk about this a little bit in your note, how much the growth of a company like Microsoft is really just a bullish signal for NVIDIA. Should investors be kind of switching their mental framework in that direction?
Well, I'd say we're just at a point where they can't both win. Either Microsoft continues to overinvest in NVIDIA GPUs, in which case NVIDIA wins, but Microsoft has diminishing margins, or it slows down that rate of investment, which would also encourage other participants to slow down their rate of investment.
But Gil, really quickly here, just because so much of the revenue for NVIDIA, I think it's 40%, comes from 4 of those hyperscaler names. So given that, wouldn't the success of a name like Microsoft be tied to more success for NVIDIA and vice versa?
Well, the success of AI depends on what applications we have and how quickly these models develop. If they continue to develop, both will win to some extent. It's just that NVIDIA is going to continue to take more and more value out of Microsoft if Microsoft continues to overinvest. But right now, Amazon and Google are just in a better position because they can also rely on their own chips, which cost a lot less.
Gil, what would it take then for you to be bullish once again on Microsoft. Any future investments, anything that you want to hear from executives in the coming quarters that you think is going to then turn the momentum back into Microsoft's favor, or because they're already lagging behind maybe on their own chips, it's something that is going to take time then to catch up from here?
Actually, it would be the cooling down of investment. If they go back to a steady state of investment and expand data centers, but not at this exponential rate, that would take away that margin headwind and position Microsoft for much faster earnings growth. Right now, they're all in a big arms race that's well ahead of the return on investment that should come from this investment. And so if Microsoft actually cools off its investment, margins will grow and they won't really sacrifice any revenue growth.
All right, Gil Luria, really appreciate you joining us. I know it's early in the morning for you, so thank you so much for popping on. We appreciate it.
Thank you.
Coming up, more trending tickers on the other side of this break. Stay tuned with us for more. This is Catalysts. It's now time for some more of today's trending tickers. You can scan the QR code on your screen below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Bank of America getting bearish on luxury, downgrading Louis Vuitton parent company LVMH and Gucci parent Kering to neutral. Also downgrading Hugo Boss to underperform. Price targets also slashed across the sector, and you can see the reaction here in some of those stocks. LVMH down about 0.2% and Kering down over 2% here. Hugo Boss, though, moving to the upside on some individual company news. Having said that, of course, this relates to the story that we've been talking about all morning, Shauna. It's the China of it all, right? We know that slowing growth in China, which is a key luxury market, is raising concerns here. And we had a slew of negative economic data coming out of China in August that indicates no good news to come from this sector. Meantime, the luxury sector overall down 13% so far this year, while we are seeing growth in broader indices globally, like the global MSCI Europe index, up over 7% in comparison. So that's indicative of the degree of downside pressure that's specific to luxury. And Bank of America is saying that luxury firms need to refocus on creativity and fashion innovation to drive more volume.
Yeah, and I think that this is just a continuation of what we've heard from so many of these executives here over the last several weeks and over the last couple of quarters. The slowdown in China obviously being a huge headwind for this sector. And it's important to point out that Bank of America is not alone here in their call for a little bit more of a downward pressure here in some of these names. You had Goldman and Jefferies also out saying that they expect to see further earnings pain to come because of demand from Chinese shoppers remains muted. So of course that begs the question as to how long it's going to take for this turnaround and to gain some traction, whether or not we are going to see additional stimulus there. Of course, we have the unusual, maybe is the best word to put it, a meeting amongst Chinese policymakers tomorrow. We could learn a little bit more maybe about what their policy plans look like going forward. But again, some pressure across the board on some of these names. That is expected from Bank of America, some of the colleagues on the street, because of that ongoing pressure in China. Now, looking at the healthcare and utilities sectors, after Morgan Stanley was out with a call on this, recommending investors lock in their gains on defensive stocks. Investors who had been anticipating an economic downturn have been flocking to sectors more immune to a recession. Now, Morgan Stanley's Mike Wilson is pointing out that defensives tend to underperform in the month after a Fed's first rate cut. We've actually heard this from some of our strategists here over the last couple of trading days. Now, we did see a huge buildup in some of these defensive plays ahead of the Fed's decision to cut. So, of course, the question is what the valuations are right now. If the valuations are a little bit too pricey, if we may become a little bit too far too fast. He's talking about the importance of the next jobs print, and maybe that is going to give us a little bit of a better idea as to what the future looks like for this group.
Yeah, and important context, of course, for most of us know Mike Wilson typically very bearish. He just recently turned a little bit more positive on stocks for 2024, given the outperformance that we've seen, kind of pushing his hand there. Do want to mention the Citigroup basket of defensive stocks is up about 11% just since the end of June. That outperforms the broader cyclicals index. But Mike Wilson saying it's time to take profits off that recent outperformance because, like you said, Shauna, lack of clarity about what the job market and the labor market data could look like. If the data, is horrible, that could be a boost for defensive. It could make it look like we're heading towards a recession. But if it's great, that could be bad for defensive. So while we wait for that clarity, better to just take some profits, according to Wilson here. All right, we are going to have all of your markets action ahead right here on Yahoo Finance. So stay tuned for more. We've also got a programming note. Join us as markets editor Jared Blickery sits down with A-list strategists to decode the day's market moves, from the word of the day to who wore it better. This is Yahoo Finance in its best form. Stocks in translation every Tuesday and Thursday at 8:30 a.m.
All three major averages in the green this morning as Wall Street looks to build on a record-setting week. Now investors are face a packed week of economic data and Fed speak that could make or break some of that recent market momentum. So let's talk about it with Krishna Mamani. He's Lafayette College's Chief Investment Officer. Krishna, it's great to have you. So as we're speaking right now, we're getting some headlines crossing from Chicago Fed President Austin Goolsbee. He's talking about the fact that he at least believes rates are way above where anyone thinks neutral is. He also went on, though, to say that consumer spending remains very robust. Growth is strong. I'm curious just your reaction to that 50 basis point cut decision, and maybe ultimately, given the fact that the economy still seems to be resilient, what the odds are for another 50 basis point cut in November.
So I think I was expecting a 25 basis point cut rather than 50. But I would take 50 just as much as 25. The point is the level of rates is significantly higher than where it needs to be, given the slack that is developing in the labor market. And I think the Fed is convinced of that. And the person who probably would have opposed it the most, who made it clear that he didn't want 25, folded. That was Waller. So Goolsbee is probably the most dovish member, and you would expect him to say things like significantly higher level of rate cuts coming. The bottom line is the economy is in a good place. Rates are too high relative to where it needs to be. We will probably see continuous downtrend in Fed funds rates over the next 12 months. We are in a good spot in terms of the overall the dynamics of the market as a result.
Krishna, do you begrudge the Fed for going 50 without a clear signal?
Well, so I think if they had gone 25 in July, they wouldn't have done 50. But because they didn't go 25, they can justify that 50. Powell was very clear about the fact that we should not expect more 50 cuts in the near future. Having said that, I think it is also clear that much the way that they pivoted from no cut in July to 50 in September, if you see significant downtrend in employment over the next few months, they will pivot just as hard for another 50. I don't expect it because I think the economy is doing well. But the point is they are on the case, and if the economy slows down, they will cut more. Inflationary pressures are not building up, so the upside is very limited in terms of rates. So I think overall, the situation for both the economy and the markets is pretty good.
Krishna, is the market maybe a little ahead of itself, at least at this point, just given the fact of the pricing right now and the optimism that we are going to get 50 at the next meeting?
Yeah, so I think the 50 at the next meeting is, given what we see in the data today, is very challenging. That is, if you have 3% GDP growth rate, which is where Atlanta Fed is kind of lining up, it's kind of and strength that you see in other real-time indicators. It's very difficult to see how employment rate is going to be meaningfully weaker, which is what you need. Having said that, we have seen the near-term data flip-flop over the last 6 months. There is a possibility. I don't assign a high probability. And if employment remains strong, expecting a 50 in the next meeting, I think is a bit unrealistic.
So what is the biggest thing the market should hang its hat on to suss out the degree and pace of cuts to come? I know Powell would say it's the data, but should it also involve monitoring articles from certain news outlets?
No, I think at the end of the day, this is a very data-dependent Fed. And I think when the data was strong early in the year, they postponed potential cuts. And when data started weakening, they jumped on a 50 basis points in September. So I think we should take it at face value, whatever they are saying, which is they expect economy to be reasonable, and therefore another 50 basis points for the rest of the year, as opposed to the next meeting, I think is what we should expect. But if economy weakens, we should definitely expect them to be far more proactive, or be proactive and act accordingly.
So, Krishna, it sounds like it could be a choppy couple of weeks, couple of months here for the markets. I'm curious, just the leg higher that we've seen in small caps. If you take a look at the Russell 2000, up just about 2%, I believe, in the past 5 trading days. There has been a lot of optimism, it seems like, already priced in. Do you think that momentum still remains to the upside for the group?
Well, so I've been a long-term small cap investor to my regret, and I would still say that the market setup that we have today is really not that favorable to small caps. So you probably need early cycle dynamics for the small caps to do very well. Right now, what we are dealing with is economy doing well, Fed cutting. That is really more of a large cap story rather than a small cap story. Once the economy goes into a recession and we start coming out of it, that's when we'll see small caps do well. But before that, we'll probably see significant underperformance out of everything before we get there.
But it sounds like that's not your base case. You said markets and the economy are looking pretty good.
Yes. So I think that's why I'm saying it's still a very much a large cap game. The challenge with large cap is valuation. So the trend is higher. The trend is higher for the overall markets, and it's probably higher for small cap as well. But large cap's doing much better. The challenge is, given valuations, the path is not going to be linear. It's going to be choppy, as it has been for the last 3, 4, 5, or at least 3 months. We will make some progress, give it back, and then start all over again. That's how it is going to be until after the elections.
So given that, and I know that you're a utilities guy, on the sector level, we're seeing some positioning that looks a bit defensive. Do you think that we're seeing some sectors coming out of a recession and others that are prepping to potentially have one?
Well, so I think the utilities move was really more a rates move than anything else. And I think given the direction in rates that we had over the last 3-4 months, it was fully justified. But we are already there. 10-year rates, likelihood of 10-year rates at this pace of economic growth and expected rate cuts, I don't think there's much downside in 10-year yields. And if that is the case, we are probably capped out in the utility sector and defensives for that matter.
Krishna, when you take a look at the election, I guess how much clarity do you expect the markets to glean from those results? And obviously, it will offer a lot of clarity when you find out who wins the election. But I just mean from a policy perspective, what has already been priced into the market, some of that outperformance that we could see depending on who is elected to the White House. When should investors start adjusting their portfolios, or when should they start thinking, I guess, more seriously about that change and ultimately what it means?
So I think the biggest issue from a market's perspective, from an economic perspective, is really about tariffs and whether a potential Trump administration would impose tariffs. Other than that, the likely impact of anything happening or any election result is relatively modest. On that front, we probably would not find out anything for a long period of time. That's not something that is coming out in January or February, so that you have to react to it in November. And there's a decent probability that none of it actually comes about, because it may be just election-related posturing. So I don't think there's any rush to adjust your portfolio. The rush to adjust the portfolio would be if the economy started slowing down meaningfully. That doesn't seem like the case right now.
All right, Krishna, always great to get a sense of optimism from you. Really appreciate it. That was Krishna Momani over at Lafayette College as the Chief Investment Officer. Thanks.
Thank you.
Coming up, we got a bullish call on Tesla. We'll tell you what investors need to know next.
Shares of Tesla are moving to the upside. You're looking at gains of more than 4%. That move being driven by a call out from Barclays. Barclays analyst Dan Levy saying that they expect third quarter deliveries to rise 8% year over year to 470,000 vehicles. Now, the reason why this is significant is because it's handedly above the 461,000 that is consensus right now. It's based on July data for the global EV sales and also August registrations, production in Europe and in China. Now, third quarter volume strength driven almost entirely by China, while Europe is weak. That's something that Levy also pointed out within his notes. In terms of what that upside looks like, we know that Tesla obviously getting to the highest level that we've seen, or some of that momentum, I should say, what that has looked like. You're looking at a year-to-date chart. The stock essentially unchanged. But take a look at that move to the upside, especially since the middle of August towards right now, because we are looking at the highest level that we've seen of Tesla since July 23rd. So we have seen a bit of a bullish momentum return to the name. Of course, it was also one of the big drivers on the heels of the Fed rate cut last week, the 50 basis point cut, viewed as a bullish sign here for many of these growth names. But again, Dan Levy saying that he expects third quarter deliveries to be stronger than what street consensus is, and he's expecting that to drive the stock higher.
Yeah, and it's interesting what he says about China in particular, which you did touch on, Shauna, but just to emphasize this, talking about how company performance in China in particular could set a quarterly record of deliveries around 179,000. That would be the best ever for the quarter. And interestingly says also, we assume China's strength is more a function of better macro and EV demand, but it's also possible that incentive pricing or even some renewed interest ahead of the 2025 launch of full self-driving technology, which, as you may remember, Elon Musk secured the possibility of full self-driving in China after traveling to Beijing and meeting directly with Xi Jinping, something that is clearly and potentially leading to increased deliveries, but certainly noted by this analyst as something that could drive further outperformance in the region despite some of the economic challenges there. All right, we are going to stick here with tech. Tech stocks moving to the upside just ever so slightly today. A little bit of a mixed performance here, though you are seeing recovery in the likes of Microsoft following that call with Gil Luria. We had him on earlier. But remember, tech hitting record highs following the Fed's rate cut. Our next guest, though, seeing outperformance in two of the Mag 7 names in particular. Joining us now to discuss, we've got Mark Mahaney, Evercore ISI's Senior Managing Director and Head of Internet Research. Mark, thanks for joining us. We're going to get to your individual company calls, but I do want to start on the broader sector. To what extent is the path forward for the Fed playing into your overall outlook when it comes to large cap tech names?
Okay, well, thanks for having me on, Madison. I would think that it creates a kind of a benign environment for mega cap tech stocks. If we go back if we replay the tape over the last 2 years, the beginning of 2022 was a terrible period for tech stocks, for long duration assets. And because we went from 0 to 100 or from 0 to 5% in terms of interest rates, unprecedented spike in interest rates, and it really crushed the tech sector. We had 30, 40, 50% sell-offs. Ever since then, ever since the rate path has stopped rising, and then we've just been waiting to see just when it would start, when we'd have rates come down, we've had this pretty material outperformance in tech stocks. And now that the rates are starting to come down, that should help as well. I think a lot of this is anticipated into the stocks, but still, a declining rate environment is generally good for long duration assets like tech.
So, Mark, you have encouraging, optimistic outlooks on a number of these names, but I want to zero in on a recent note that you just published on Amazon. You raised your price target on the stock. You raised it to $240. That was up from $225. And you're talking about in this report the focus from Amazon ramping up their opportunity within Prime Video. Give me the so what factor. Why is this important? Why is this significant? And ultimately, how is this really going to drive some of that business going forward?
Okay, and this is, Amazon advertising is just one part of the business. Amazon is so big as a company, it's kind of hard to hit a lot of home runs from here. It's all singles, really. But this is a good single, and that is, the company does about $50 billion a year in ad revenue. It's actually the third largest ad platform in the world. And there's a lot of still unmonetized or lightly monetized areas. Amazon Prime Video, they only started really directly monetizing Amazon Prime Video in January, when people were kind of opted into an ad-supported plan. You could pay $3 a month to get out of that, but you started seeing ads, and they started bumping up the ad load as you've kind of gone through the year. and they're coming to market with reasonably or relatively below market price, especially versus say like a Netflix in terms of that ad inventory. So it's it's been an undermonetized asset, and it's a great opportunity for Amazon to scale up another revenue stream. And what the so what of this is, I think it's going to allow Amazon's ad revenue growth rate, which has been around 20%. I think it'll allow it to accelerate going into next year. And then this is very high margin business. If you take a look at Amazon, you look at retail, 5% operating margins, cloud is 30%, advertising is 30% too. So anything to boost the growth rates for either cloud or advertising is good for the business overall. I call it the best mix shift story in tech, i.e. the fastest growing assets have the highest margins. It's good for Amazon's margins too. That's the so what.
How much do the NFL games on Thursday nights play into that broader ad revenue call?
Oh, it's a big bet that the company has made on live sports. So they've leaned more and more into Thursday night football, and I think they're going to be carrying a wild card playoff game this year. But there's more sports content, live sports. The NBA, we do call out that the PPA, the Professional Pickleball Association, is having its World Championships on Amazon Prime. But just in general, on a more serious note, there's just a lot more live sports content that's on Amazon, and I think that's going to be one of the biggest investment areas for the company over the next 3 to 5 years. And you can monetize that. By the way, sports carries some of the highest CPMs out there because it's a rare opportunity put together that kind of intense audience. So size and frequency of that audience. So yeah, I'd expect to see more of that from Amazon.
Pickleball, everyone loves pickleball these days. Mark, let's talk about your other call or your recent note that caught our attention, and that was Alphabet. You were discussing the fact that obviously we have Alphabet, Google back in court here, talking about just those regulatory concerns. And what stuck out to me about your note was that you still have an outperform rating on the stock, but you were talking about and testing that worst case scenario. Walk us through that worst case scenario, why you ultimately maybe don't see changing your long-term outlook for the name.
Well, there's a lot of uncertainty over Google, and I think if you want to be long the stock, want to buy the shares, you have to be pretty long duration about it. Like, I don't think there's a quarter call here or a 6-month call. I think you have to be willing to look out a year or two. I think Amazon works better near term than Google does. Google's not one of my top 3 picks now. And it's sort of these two pincers, I guess, on the stock. There's this concern about AI-driven competition, that's ChatGPT, and then there's concern about this DOJ regulation trials. I mean, Google was found guilty, libel in district court for being a monopolist. And so how this actually plays out, we're going to know by next August what the exact remedies are going to be. Google will appeal that, and it could double appeal that. And that could they could take some time. But anyway, there's something there's going to be a change at Google. They're going to have to either reach some settlement, or they're going to have to deal with almost certainly the loss of the ability to write these exclusive distribution deal checks that they've been writing for the last 10, 15 years. The offset you have, if you're looking at it from the long side, is that it's a lot of savings you could potentially get from Google. They spend over $20 billion a year on what are called traffic acquisition costs, or payments to be the default search provider. So if they are legally enjoined or no longer allowed to make those payments, that means there's going to be some savings. So you probably have a lot of protection in terms of your earnings estimates for the next couple of years, but you could well see a hit to your revenue estimates the next couple of years. And so that's why it's going to be, and I don't know if anybody has any huge visibility into this, but we'll get more as we go through the search trial and the hearings over the remedies. We'll get more of that in the next 3 to 6 months. And I think, we think that'll probably create an interesting long opportunity in Google. That's why we're sticking with it. We think current valuation is also highly reasonable.
Mark, just give me one or the other. Which is the bigger risk to Google search dominance, antitrust or competition in the search space?
I'm guessing antitrust. I think most people would say, I think a lot of market participants would say ChatGPT, but I think actually people underappreciate just how much better Google search has become, and I think they've got just as many Gen AI tools as anybody else, probably more. They've got more data than anybody else. So I'm more worried about DOJ.
All right, Mark Mahaney, we have to leave it there. Thanks so much for joining us here this morning. Senior Managing Director and Head of Internet Research at Evercore. Thanks, Mark. Coming up, we've got Wealth that's dedicated to all of your personal finance needs. Brad Smith, he has you for the next hour. Stay tuned. We'll see you tomorrow.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, we're going to talk about the 3 loans that you should consider refinancing now that the Fed has started its policy easing cycle. And with high home prices and mortgage rates, many buyers have been sidelined. But with the Fed cutting rates, is now the time to come off the sidelines? We'll discuss that with Redfin's chief economist. Plus, ditching the college debt. We'll get you some expert advice on the best ways to save on your education. All that and much more coming up on today's show. But first, the Fed will once again be top of mind for investors this week as they seek more guidance on the size of the central bank's next rate cut anticipated in November. Here with his perspective on how to manage your portfolio and the sectors with some opportunities for potential gains, we've got Dan Skubis, who is the FM Investments Senior Portfolio Manager. Dan, great to have you here with us. All right, so where would investors be apt to place a little bit more attention on a sector basis after a 50 basis point cut that we saw at their September meeting, and now looking out to the rest of 2024?
Right. Well, good morning, Brad. I think with the Fed rate cut, I mean, I think they really gave the message that, this wasn't a rate cut to prevent recession or excessive slowdown, but more about the belief that they think that they've won the inflation war. And so I think that's more, and I think what you've seen from the markets is that the more bullish take, raises the risk or raises the opportunity for the soft landing. And so, for us, there's 3 distinct areas that we think that there's opportunities. And, one of them is more from a secular perspective on the data center, electrification, and infrastructure areas. The second is from a reshoring perspective, which is still taking place even after the pandemic, has taken place. And then I think the last area is an area with housing, and specifically, we've seen the home builders hold up very well, but some of the more building products areas have not really participated, and that's where we see some more of the better opportunities.
And so with that in mind, I mean, the playbook that we've been continuing to try and get a good sense of for a soft landing here, how much risk do you think investors can still have in that playbook and in that portfolio?
Well, I mean, I think, the thing that everybody's watching is the employment data. And I think as long as employment holds up, the chance of a soft landing goes up more. And I think in that kind of environment, the market's going to be more risk on, and investors are going to have a better opportunity to make money in that type of market. If we do see any kind of more material slowdown, say, job growth under 100,000 in one of the upcoming reports, I think then the market gets a little bit more concerned, and we see more of a risk-off environment. I think that we hold in better. I think, all the signs that we're seeing from retail sales, industrial production, and then, some of the payroll data that we've been seeing recently would indicate that it looks like we're going to be able to hold up in that type of environment. And so we think that there's a great opportunity for some of these more, maybe more risk-on type areas where we see some better growth opportunities.
Coming into the start of this year, all the talk was on small and mid-caps, SMID-caps, if you will. I mean, what's been taking place to your assessment to the extent that, it hasn't really outpaced, it hasn't outpaced at all? I mean, you compare it to the S&P 500, S&P 500's up 20% year to date. Russell 2000 only up about 10%, a little more than that over that time. So what does the future hold for small and mid-cap, and how should investors be keeping tabs on that?
Yeah, it's a great point. I mean, so we focus on the small cap side of things. So for full disclosure, and so we've been feeling the brunt of it for a number of years now. And I think what we're seeing is that a lot of investors are very underexposed to small caps, and that's really worked for them. I think you mentioned the Russell 2000 being lower. It's been a better environment for active management in this space. Because quality has mattered, and the Russell 2000 really is a kind of a lower quality type of benchmark. And so, it's got about 40 to 45% of the names within the Russell 2000 that don't make money, don't have earnings. And so we've been able to find, better opportunities within that market. I think, given the historical level of underperformance of small caps versus large caps, I think it's more of a matter of when than if that small caps start outperforming again. We've been kind of saying for a while that it's, we think that at the very least, investors should be sharpening their pencils on smaller cap names, with it more being a market timing type issue than kind of a should I or shouldn't I issue. And so I think that, with the rate cuts along with continued U.S. economic growth, I think that's a better environment for small cap stocks. And, you saw this back in July when the Russell took off on better growth expectations. The pent up demand is there. I think people are looking at this. They understand the small caps have been underperforming. They see the opportunity for small caps to come roaring back, and they're ready to put money there. But, with the growth scare in August, a lot of that came back out. So I think people want to invest there. It's just waiting for a little bit more conviction that it's going to stick.
So is it better to index towards the Russell 2000 in that instance then, or the S&P 600 where you've got that profitability filter?
Yeah, I mean, I think, as I said, more of an active management role is going to outperform better. And so if you look at the S&P 600, it's more of a managed index. And so that index is focused on only companies that are making money. And so in that environment, I would expect the 600 to do better than the Russell 2000. And I think in that environment that active managers can do better because of, the opportunities within small caps to find those names that are going to outperform over the longer term.
Dan Skubis, who is the FM Investments Senior Portfolio Manager. Dan, thanks so much for taking the time here with us today.
Yeah, thank you, Brad.
Certainly. Guys, falling interest rates could mean now is a good time to consider refinancing. So what is refinancing? Let's just take a step back and define this first and foremost. Refinancing, it means revising the terms of a debt obligation, especially in regard to the interest rate or payment schedule. Now, you might be able to work out new or better terms on your existing loan, but refinancing may also mean taking out a new loan with the same or different lender. So let's look at some of the types of loans that you can refinance. 1, a mortgage loan. 2, an auto loan, and 3, a personal loan here. So let's break these down. When should you refinance your mortgage? Refinancing your mortgage could be a good option if interest rates have dropped since you obtained that mortgage. You want to use your home's equity perhaps to pay for large expenses, or you want to change your loan structure or term. So for example, if your credit score has improved since you took out your mortgage, you might qualify for better terms now. In an interview with Yahoo Finance, Melissa Cohn of William Raveis remarked that as the Fed lowers its benchmark interest rate, there's been a tremendous amount of pent-up demand for people who have wanted to refinance, either to consolidate a higher rate home equity loan or to pay off credit card debt for home improvements. Now, what about when you want to refinance your auto loan? Yeah, vroom, vroom here. Similar to mortgages, experts say you should refinance your car loan if auto loan rates have dropped since you took out the loan or your credit score has improved. So, refinancing could put you on a faster path to paying off your car. On the other hand, if you're struggling to keep up with payments, you could refinance to a longer term and lower your monthly payment. And lastly, when should you refinance your personal loans? Now, refinancing your loan almost always makes sense if it will save you money. That means locking in a lower interest rate, either because you have a better credit score to qualify for a lower rate, or interest rates overall have come down, as is the case now. On the other hand, if your income has decreased, you could refinance and get a longer repayment term to lower your monthly payments. Well, on the other side of this short break, we've got much more on a new report showing rental affordability has improved across the nation. Want to know if it's in your town as well? We'll find out next.
So how much house can you afford? Here's how to figure that out.
The really obvious factor that affects housing affordability is the home price itself. But there are two other factors that are really important for housing affordability. One is the mortgage rate. The other major factor is, of course, incomes. So those are the three legs of the housing affordability stool.
Of course, affordability is a quality of life calculation, so only you ultimately get to determine what works best for your monthly expenses and budget. But determining how much house you can actually afford starts with some basic details that will help you figure out what your biggest and most important monthly cost should reasonably be. A key first step is to plug the following into a housing affordability calculator. Your household gross income, that's your annual pre-tax income. Your debt, think monthly payments on loans and credit cards. The down payment, a percentage of the purchase price of the house paid up front. The loan term, the duration of the loan. Interest rates, interest paid during the loan term, which can vary based on credit score and market conditions. Mortgage insurance protects lenders in case a borrower defaults. Property taxes, a variable cost paid to local governments based on the value of the home and the land it's on. And of course, closing costs. To start, identify your household's gross annual income and gather 3 months of bank statements to estimate your debt payments. Plug that into the calculator. For this example, let's use $100,000 as the gross annual household income, a bit more than the median, with monthly debt servicing payments of $500. Lenders assess the percentage of your monthly income that goes towards paying your debts, your debt-to-income ratio, to determine your financial health and ability to take on a mortgage.
A lot of people go with the 30% rule of thumb for the housing costs. That's keeping your housing costs to no more than 30% of your gross income. Anything in that range should be comfortable for most people, but like most rules of thumb, you should think about how it applies to you individually.
Slew of housing data last weekend. There's even more on deck this week. Get excited. The Case-Shiller Home Price Index, new home sales, and our weekly mortgage rates data, all this week. So far in August, the read on the housing market, looking back at that month, appears mixed. New home constructions are higher, and home builders are more optimistic about the future as mortgage rates are dropping significantly here. Meanwhile, buyers are still on the sidelines. Existing home sales fell more than expected in August. Here with her take on the market, we've got Daryl Fairweather, who is the chief economist over at Redfin, joining us live in living color in studio. Daryl, great to see you.
Great to see you too. I'm so happy to be here.
Let's talk about this a little bit. I mean, what is the overall read from your assessment of the housing market right now, even as the Fed delivered what was a shock 50 basis point rate cut that's anticipated to maybe already be priced into some of the mortgage rates that we're seeing right now?
The housing market has been in a freeze for the last 2.5 years, and these rate declines are bringing buyers back to the market. Before, they were sitting on the sidelines waiting for rates to come down. Rates started to come down, and they were a bit slow to react. But now that it's all over the news that the Fed has cut, we're seeing more buyers interested in touring homes and getting ready for that next spring season.
I feel like we've talked about this time and time again, but how low do you believe that we need to see the 15 or even the 30-year move down towards to really ignite and light a fire under those who have been sitting on the sidelines trying to get into the housing market?
Well, since earlier this year, the typical home buyer will end up paying $400 less on their mortgage, and that's a big amount of money. On the West Coast markets, it's like $1,000. So I think it's already moved enough to make a difference. It's just that people are still waiting for rates to drop more. They're waiting for more inventory. So there's no real fire under people. There's still time, but the longer people wait, the more they're going to end up competing against other buyers. Because if you're an early bird, you're going to be more likely to catch that worm.
I mean, it's a constant kind of jousting that a lot of potential buyers or even first-time home buyers are doing, which is it better to rent right now or is it better to own? I mean, where is that netting out right now at this juncture?
You know, if you're just looking at your monthly housing payment, it's still going to be more affordable to rent in most markets. But the thing is that rents are likely going to keep going up. Home prices will keep going up. So if you don't lock in with that home price now, you may end up paying a lot more later. But it's a hard trade-off. If you're going to be moving a lot, like moving within the next 5 years, I would say keep keep renting. But if you're ready to settle down, I think owning a home is going to be more better for you financially in the long run.
And if you are getting out there for the first time, there's a new part of that experience for you, which is engaging with a real estate agent. But there's some significant new rules from the National Association of Realtors as well that could impact that relationship or the percentage payouts as well. What do new home buyers and even people who have bought a home before but had a different experience under the previous pretenses need to know about these changes?
Yes, there are new rules. It used to be that if you were a buyer, you didn't really have to, pay a lot of attention to how your agent is paid. The seller would pay the buyer's agent. But now buyers are paying the buyer's agent directly, and they need to set a contract at that first tour, or at least sign something that outlines how their arrangement is going to go. And that's one thing that's holding back the housing market right now, is people are just intimidated by that agreement and this new procedure. But I think over time, as it becomes more normalized, people learn from other people's experience, it'll start to feel more natural and it won't be that big of a impedance.
When we think about the amount of supply that still needs to come on the market to meet demand, I mean, ballpark, what are we talking about right now in terms of the number of new homes that also need to be built out as well?
It's going to take years and years of building new homes to get to a place where we have sustainable affordability. I know that Harris has talked about building 3 million homes over her term, and those are the kinds of numbers that we actually need to get to, and it's going to require a lot of federal investment. If it's just the private market, I think we will see more new construction next year, but they're motivated by higher prices, and so I don't think it's going to be enough to make prices stabilize. The new construction will help. A lot of homeowners are locked in. They're not selling, so more home buyers will go to new construction, and that will be good for the long-term health of the housing market, that there are these new units coming online.
All right, you tell me there's some affordability up in Wisconsin, so I might have to break out the parka. I don't know. I still have to be an Eagles fan up there in Packerland, though. That's going to be difficult. Thanks so much, Daryl.
Thank you.
Absolutely. Daryl Fairweather, who is the Redfin chief economist, joining us here on Yahoo Finance. Well, while we're talking about this, renters are seeing some sign of relief. A new Realtor.com report shows rents across the biggest metro areas in the U.S. are falling. Median rent prices for the month of August are now sitting just above $1,700. So can we expect the good time to last here? Yahoo Finance housing reporter Danny Romero has the details. I mean, the good time to last in terms of hopefully some depreciation, or at least prices coming down a little bit?
Well, this is the time to really take the opportunity, if you want to stay in the rental market, to be in the rental market. Rent is a lot more affordable this year compared to last year. Realtor.com reported that in August, rents came down around only $5 to a little over $1,700. Yes, but we're talking about it on a yearly basis, right? So here are the most affordable rental markets. It's Oklahoma City in Oklahoma, Columbus, Ohio, Round Rock in Texas, Kansas City, Missouri. Now in these markets, rents are around $1,000 to $1,500. Now the least affordable market still remains Miami, Florida, Los Angeles, California, New York City, of course, in New York, San Diego, California, Boston, Massachusetts, and this one was a little bit of a surprising one, Riverside in California. Rents range around $2,300, to $3,000 per month. The bottom line is that housing affordability is still going to be a challenge. Rents are still 20% higher than they were in pre-pandemic levels. Looking ahead, economists are expecting, though, that affordability will improve in the rental market as there has been this influx of supply that has been added to the market, which will put pressure on rent prices. Brad?
I mean, we know Americans want more affordable rents, but as we're thinking about this climate, what else are renters looking for at this juncture?
This caught me really off guard. Zillow reported that renters are looking for pretty pet-friendly areas.
Pet-friendly.
Pet-friendly.
Okay.
That's a number one.
Top of the list.
Yeah, a top amenity for people. They really want to find an area where they can take their dog, like a turf area specifically. And we can see that here in New York City. There's so many dogs around in the city. And they're also looking for a space to do social activities. They want happy hour time. That's what they're looking for. They're looking for a place where they can do these social activities. Aside from that, Zillow reported that renters are also looking, of course, at the amenities to where they can park their car. There's the off-street parking, in-unit laundry, which is a big amenity. Those are really top priorities. Another surprising thing that renters aren't looking for are fitness centers or even business centers, which I thought was really interesting. But renters still want the wow factor. So if you have a bowling alley, people are going to be, they're more intrigued by those like wow factors.
All right, bowling alley and a place for Fluffy. That's what people are looking for. Danny, thanks so much. Appreciate it. Well, you may have heard Fed Chair Jerome Powell over the last few months repeat over and over again that the Fed is targeting a 2% inflation goal. So how did that number become part of the Fed's mandate? Yahoo Finance is here to explain.
The Federal Reserve has a dual mandate: maximum employment and price stability. And when it comes to the latter, there's one number the central bank targets: 2% inflation.
The economy has made considerable progress toward the Fed's 2% inflation goal.
The Fed maintains the economy can run efficiently when inflation remains low and stable over the long run. But why 2%? Here's how 2% became the Fed's inflation benchmark and why some want that number reconsidered. The 2% target is widely adopted by all major central banks today, but it was the Reserve Bank of New Zealand that first came up with the idea back in 1988. The finance minister at the time was facing pressure after years of double-digit inflation.
He was doing an interview as it was getting under 10%, and what happened is the interviewer just asked him, what should the target be at the end? And he just responded to it. So it was this apparent off-the-cuff moment and wasn't intended to be setting policy, even though it did.
New Zealand set its initial target range between 0 to 2%. Other central banks quickly followed, but the Fed didn't officially adopt an inflation target until 2012.
This 2% goal for inflation over the longer run should help foster price stability and moderate long-term interest rates.
There was a time when Fed policymakers attempted to cultivate an air of mystery and cloak their statements in ambiguity. Really, the person who turned that thinking around was the one-time Federal Reserve Chair, Ben Bernanke. He was at the forefront of a revolution in thinking that being clear about what your objectives are, communicating crisply and understandably to both financial market participants and to ordinary households and businesses about exactly what you're doing and why you're doing it. That promotes the objectives of monetary policy. It helps monetary policy be more effective.
The idea is to create predictability and certainty. When consumers and businesses know where the Fed wants inflation to be, it allows them to plan for the future. It gives them reasonable confidence about where prices are going.
You say what you do, you mean what you say, and you execute according to plan. That builds credibility, and credibility in turn has two key effects. First of all, when inflation takes off, financial market participants, households, businesses all have confidence that you're going to bring inflation back down to target. Secondly, when the economy weakens, goes into recession, people are losing their jobs, you have the latitude to battle back against that.
Economists say anchoring that target to 2% gives Fed officials flexibility to maximize its tools.
The Fed's key tool in fighting recessions is to cut interest rates. And so you want a little bit of a buffer for the Fed to be able to cut interest rates when times are normal, so that if the economy tips into recession, there's room for the Fed to take action against it.
That hasn't always worked. Persistently low inflation prompted the Fed to significantly tweak its policy in 2020 through something called average inflation targeting.
It says instead of having to hit 2% exactly, the average can be about 2%. So in other words, inflation can run a little hotter at times if it runs a little cooler other times.
Stubborn inflation coming out of the pandemic has reignited the debate over that 2% number.
Is there substantial economic analysis that argues that your target rate in the economy would work better if we had a slightly higher target than 2%?
2% has become the global standard. It's a pretty durable standard. I don't have any reason to think that it's a problem for the United States to get to 2% inflation.
The criticism from the left is that it puts too much emphasis on this and there's not a target on the labor market side. For instance, there's no unemployment target to balance a price target.
Republicans have largely been supportive of the 2% target. The Fed reviews its monetary policy framework every 5 years. Officials have vowed a thorough public review of its policy strategy, tools, and communication practices in 2024. But economists aren't holding their breath for major changes anytime soon.
The benefits of inflation targeting, the benefits of this approach to monetary policy, which features predictability, credibility, accountability, that has really paid enormous dividends. As painful as the inflation of the COVID era has been, it would have been tremendously worse if we'd had to pay the cost in the form of much higher inflation, a deep recession, in order to bring that inflation back down.
%51% of undergraduates finish college with student debt, according to College Board. And it takes a borrower a little over 20 years to pay off student loans, according to the Education Data Initiative. But there are some strategies that you can take in order to pay loans off quickly here. To discuss, we have Tricia Scarlata, who is the JP Morgan Asset Management Head of Education Savings. Great to have you here in studio with us.
Thank you. Thank you for having me back.
Absolutely. Let's talk about this. I mean, we're just a few weeks, months into the school year. And for those who are getting ready to go to college or those who are in college right now, a lot of those discussions on a family level have either already needed to be had or are being had as preparation for next year, making those decisions as well. And so as people are thinking about what families need to do to begin this conversation, where does that discussion start?
Well, I think what you're saying is so important because many families don't have the discussion and make rash decisions. I mean, look, we all want our kids to be able to fulfill their dreams and go to the place of their dreams. But the earlier you have these conversations around cost, I envy those families that have those conversations and say to their child, we can afford X amount. It's such an important conversation to have. And even when we talk to people about saving and investing for college, you start with the number. So yes, have those conversations early on so that you can best prepare. And also, you don't want to disappoint the child. And that's where the problem comes in. We start borrowing money because we want our child to be happy.
How important is it to really run the math on what the payoff is going to be? We always talk about return on investment, whether it's in the equity market or whether it's in an experience as well. And this is a major financial decision for families looking to make sure that they're also getting the bang for the buck on the other side too.
Well, yeah, I mean, and as far as debt, if you think about it, student debt is the second largest type of debt in this country. Yeah. Mortgages is the first. If you were to ask the average person who their mortgage lender was, what their mortgage balance was, and what their rate was, they would probably know pretty close. If you ask them the same question about student debt,
no clue.
No clue.
Yeah.
So first and foremost, and no pun intended, is do your homework. Because a $25,000 loan, which is what the average family took out in 2023, over 10 years, and just as you noted, most families don't pay off in 10 years, they pay off in 20. But let's just say you paid off in 10. That becomes $34,000 in payments. So think about what that means for your family. That's a $300 a month payment. You double that, so say you get to $50,000, which is what the average family graduates with in debt. That's a $600 payment a month. And double that, and it's $68,000 after 10 years. So again, do the homework. Understand what you're getting into. Go to studentaid.gov, look at that website, look for the updates on what's going on with these federal loans, opportunities to, whether it's forgiveness, forbearance, whatever that may be. Understand it.
Okay, we also got some tips here on screen for our viewers, just how to prepare for bills as well. What do you recommend for those who are looking for those bills, just waiting for it to show up in the inbox or in the mail and trying to make sure that they can pay down those bills as well?
Look, first of all, I always tell people, if you do have loans, I mean, it is the biggest struggle. 85% of students that have loans say that they're going to struggle. So you have to prioritize things. But it's very important to not default on these loans because in time, that default is going to hurt your credit. So you have to prioritize paying these loans off. Find out what type of repayment programs there are. If you went to studentaid.gov today, you would see multiple amounts of options for you. So don't default. That's number one. Folks are asking me today, the interest rates, the Fed just dropped rates.
Right.
What does that mean? Well, for federal loans, it doesn't mean much right now because remember that loan is locked in the summer.
Right.
But for private loans, certainly an opportunity to start looking and potentially refinance those loans.
Certainly. Just lastly, how much college debt is too much college debt?
I mean, I think that, we say the rule of thumb is what are you going to make when you graduate your first year out? A lot of these kids are making a lot of money when they come out these days, so I don't know if that's the best rule of thumb, but I think it's a great place to start. I mean, the federal government limits those loans. Where you start to get really dicey is when you take out the max on the federal and then go into private. But really start with understanding what your income is going to be and what you can afford on a monthly basis. But also think about your retirement. Think about what you're going to want to put away for your retirement as well.
Tricia Scarlato, who is the JP Morgan Asset Management Head of Education Savings. Great to see you again. Great to have you back in studio.
My pleasure.
Absolutely. Well, the Federal Reserve kicked off its easing cycle by cutting interest rates from a 2-decade high, prompting many to re-examine their existing debt in the hopes of finding some relief from lower rates. More than 40 million Americans have some form of student debt. Not all loans, though, are created equal. Borrowers who have private student loans with variable interest rates can expect some relief in the coming months, but those folks are a relatively small piece of the student loan pie. As of 2023, roughly 7.5% of total outstanding student loans were private. This is according to LendingTree. The vast majority of those with federal loans won't see any impact from the Fed's rate cutting cycle, and that's because interest rates on federal student loans are fixed. So now, There is the option to refinance student loans and secure a potentially lower rate, especially if the Federal Reserve continues to cut interest rates. But it's important to understand the potential consequences of doing so here. By converting your federal loans to private loans, you may lose some of the benefits that come with federal loans. Those include income-driven repayment plans, deferment options, and possible loan forgiveness. Private loans may also have a shorter repayment period, which means higher monthly payments over a shorter stretch of time. Before refinancing, it's important to compare your current loan to the possible refinance terms and decide what makes the most sense for you and your budget. Coming up on the other side of the break, we have a new survey providing insight into consumer spending and the outlook heading into 2025. And the details, they might shock you. We got those when they're coming back.
Are you a passionate investing bull? Maybe you love scooping up shares of NVIDIA on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
Nielsen IQ is out with their latest Consumer Outlook report with a guide to consumer spending habits in 2025. Here to discuss some of the findings is Tracy Massey, Nielsen IQ Chief Operating Officer. Great to have you here with us.
Thank you. Good to be here.
Let's dive into some of these numbers. I mean, I was looking at the growth anticipation, and I was kind of shocked, especially considering how we've been tracking the moderation in consumer spending and some of the smart spending habits that consumers are trying to implement as well. Just walk us through some of the key figures here, and I mean, whether or not that took you by surprise as well.
So we're expecting in 2025 for consumer growth to be about 6%. So you'd say, oh, wow, maybe that feels a little high. But 30% of consumers are saying they're better off financially than they were a year ago. So while things are still difficult, they are saying they'll curb their spending, particularly on things like out-of-home entertainment, out-of-home dining, those sorts of things. Like 40-odd% of people are saying reducing that. But the outlook is looking better. Inflation is slowing, so 2%. In the last 6 months. So it's slowing. It's still, their pockets are still challenged, don't get us wrong. So what cost you $100 2022 is now 117 in 2024. So there are challenges, but overall, the picture's looking pretty good.
Yeah, and that was one of the remarkable parts of this report here as well. I mean, thinking about the total dollar figure of the expected rise in spend as well, I think it was somewhere around, what, $3.2 trillion?
Yep.
And so what is that on? Is that on volume or is that on price alone right now?
So it's both, and it just depends which category you're in. So for some categories, the volume is starting to come back and pricing is smaller, but for others it's not. So as an example, snacking and confectionery.
That gets me every time.
60% of consumers are saying if the prices don't stop going up, we're not buying anymore, or if they don't start leveling. But that's where the inflation is. So cocoa prices, dairy, inflation is really high there. So therefore you'll continue to see prices. And you're getting to a place though where it's getting difficult.
What was also really interesting within the consumer outlook was the amount of buying decisions that were influenced by artificial intelligence
AI,
in some form or another. I mean, it gets me every time, I guess, as it's either showing up in my feed or even when I'm actually doing what I might think is some smart shopping online and doing some comparison shopping. AI is in there somewhere as well. I mean, what were some of the ways that you saw this showing up that could be a trend more long term as well?
Yeah, so previously, I think consumers didn't really trust AI. Now, 40% of them are saying they would use AI. They like AI helping them with what to get. So I think people don't see it as so much as interference anymore, but here's an opportunity, here's an idea for you. So it's, in some ways, it's helping you. They see it as helping them versus being an interference, but 40% say they use it. Now they'll see it, and then they'll go into the store a lot of the time and decide what to buy. So we're certainly seeing an increase in e-com, so over 11% increase in e-com, but people are still shopping in multiple places. So even though they might go online, they still go in store. So there is a mix.
All right, can't wait till that robot is greeting me at the door and saying, hey, have you gone down this aisle as well? It's got to be in there, whatever you want, in addition to the new soap that you're getting. I don't know. But lastly, while we have you here, one of the other catalysts that we've talked about a fair bit here on Yahoo Finance as well is just the impact of GLP-1s. And I was surprised to see that show up in this report as well. How might that have a larger ripple effect?
So 31% of people are saying they would use GLP-1s for weight loss or whatever. So you see that then obviously in what they're buying maybe more snacks that have protein in them. Because if your appetite is diminished and you can't eat that much, you're going to have to eat the things that are really, really important. So the type of food that they're buying is changing. And again, it doesn't bode well for snacking and confectionery.
Tracy Massey, who is the Nielsen IQ Chief Operating Officer. Great to have you here.
Thank you. Good to be here.
Absolutely.
Appreciate it.
Everyone, we've got much more on wealth after the break. You're watching Yahoo Finance.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot. Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
We're about 6 weeks away from the election day, and one thing to consider before heading to the polls is the state of each candidate's personal finances as well. My next guest says personal finances can provide a window into their financial literacy, values, and appetite for risk. Here with me now, we've got Megan Gorman, who is the tax attorney, wealth manager, and author of All the President's Money, which comes out tomorrow, Tuesday. Great to have you here in studio with us.
Oh my gosh, Brad, thank you for having me.
Absolutely.
Really
Congratulations on the book as well here. Okay, so let's talk about this. Of the candidates' finances and how they're managing their own personal finances, we talk about, where are you kind of giving the scores? Who's getting A grades, who's getting Bs, who's getting Cs, who's barely passing?
Well, it depends on what you want out of your money, right? Sure. So money is emotion, and money connotes values. So when we look at the candidates that are out there today, what you really have to keep in mind is they're across a broad spectrum. We look at Tim Walz, right? He's all about stability. He has a pension, which makes sense. His father died when he was a teenager, right? On the other end of the spectrum, you have Donald Trump. Donald Trump is an example of generational wealth transfer. He is generation 2. His father was generation 1, his children are generation 3. His job is to get the money down to generation 4, his grandchildren. And so he takes on a lot more risk, and there's a lot of complexity with his finances. Now, he's also not very transparent, which can cause people to be concerned. So you've got them on either end of the spectrum, and then you have Vance and Harris in the middle. Okay. And Vance, started out poor, but he got a lot of the things I talk about in the book. He got the chance to get a great education. He went to Yale Law. At Yale Law, he makes connections that allow him to go out, write a book, get in venture capital, and then he does something that a lot of presidents did. He marries up. And he marries a woman who he even says is smarter than him and came from a wealthier background. And then that takes us to Kamala. And Kamala is all about doing everything conflict-free. She's a good student, right? Very diversified ETF portfolio, has a great estate plan. She's clearly merged her assets with her husband. We can tell that from the plan she has in California. So she's much more slow and steady wealth building.
Interesting. And so why should we care? Why should we care about candidates' personal finances here? I mean, why is this so important and something that people should think about as they're going to the polls?
It tells us who they are. Like when they're out on the trail talking to reporters, they're giving you political sound bites, right? Yeah. But if you really think about it, when you carve into their tax returns, their estate planning, their portfolios, what you start to see is who they really truly are. And so look, it's not everything, but money is very humanizing. And what you realize is some of the candidates, either today or over the course of history, have struggled with money just like all of us have.
Who have struggled the most with money of past presidents?
Oh, well, who's not good with money and struggled with it was Thomas Jefferson, incredibly illiquid. Same thing with James Monroe, right? You saw these guys borrowing from Peter to pay Paul. But when you see people struggle, it's not the struggle as much as you want them to be able to navigate the ups and downs, to be able to pivot, right? And who was great at pivoting? Jerry Ford, Jimmy Carter, right? Eisenhower, all great at navigating the ups and downs. And so that's what makes the American dream great. But it also makes it that it's much still relatable today to everything that's happened in the past.
What can we extrapolate about how presidents or candidates have managed their money into how that might translate into policy as well?
Yeah, so look, I think what's really important to the American public today is that Americans are cynical. They feel that politicians get into politics to make money. And there's truth to that, right? I mean, think about it. All 4 of these candidates, whether they win or lose, are going to get book deals and speaking tours and so on.
It's hard not to think that when they're selling hats and we've got T-shirts and there's mugs and bobblehead dolls, there's industry around it.
Right. And most Americans want that conflict to go away. When Pew Research has surveyed them, they don't want conflict. So when you look into their finances, you get a sense of, are they willing to sacrifice themselves and be patriots and their money in order to, pursue office? And so you can look at people and say, look, I'd rather have somebody who's very into risk and chasing return and so on, and that turns you on for who you want to vote for. But a lot of people want sort of clean politicians, and it's very hard today.
Is it clear of any of the candidates for crypto and what we've heard them talk about? where they all line up and where we could see some type of major, at least shift or acknowledgement in the work that needs to be done there.
Yeah, look, I mean, if across the board, crypto is going to be impacting the next presidency.
Yeah.
When we look at the actual candidates' finances, you're seeing Trump and Vance, who clearly have exposure to it. Doesn't mean that Harris and Walz won't be open to it, but what's important going forward for anyone who becomes president is how are we going to regulate this market? How are we going to make it appropriate for Americans to truly get access to it and really participate appropriately? Because again, we don't want people taking on any unnecessary risk.
Yeah, if only Jefferson had written the Bitcoin white paper and invented the internet back then, might have been in a different financial strait.
Exactly.
Megan, thanks so much for taking the time.
Thanks for having me on.
Megan Gorman, who's the author of All the President's Money, available tomorrow. Let's do a final check of the markets here as we are rounding out this 11 a.m. hour, taking a look at the Dow, the S&P 500, and the Nasdaq. We've got it there for you on your screen. We are now higher across the board for the Dow, the S&P 500, and the Nasdaq, all fractional moves as they may be. We've got a lot of time until the closing bell. That's it for Wealth, though. I'm Brad Smith. Thank you for watching. Oh, yeah, since I mentioned the closing bell, stay tuned for Market Domination. That's with Julie Hyman and Josh Lipton coming up at 3 p.m. Eastern Time. They will count you down to and through that closing bell. You don't want to miss it.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot. Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains.
We're off for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.